Fed doesn't just have to figure out how much is inflation. They have to figure out where do we put the interest rate long term.
Are there more hikes to come? How do they comment inflation? And we have seen that the Fed speak has been moving markets.
Equities and rates, they are still working in a way paired off, like teeter-tottering like they're supposed to.
If the economy is not in recession and inflation is in the 3 to 4% range, you're not getting a Fed that's easing.
It feels like to me that the Fed has really almost locked in a game plan here. They want to get rates just above 5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Retail Sales Wednesday.
After Inflation Tuesday.
Oh, there we go. From New York City this morning. Good morning, good morning. I'm pleased you're buying into that story. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures down 1/3 Neil Dutter of Renmac yesterday said this: forget higher for longer. We still need to get higher. TK, a lot of people jumping on board.
Yeah, it's really interesting tape yesterday. We'll go into it here. I'm going to give a shout out to Liz Young, who appears with us every once in a while. And Liz Young's got some great charts on the feed. And I'm sorry, it's a shelter sum up. And are we spending on retail sales, or can we not afford it because of rents, mortgages, homes, that? I mean, to me, it's really interesting, the linkage of Tuesday and Wednesday.
We're going to find out 8:30 Eastern Time. Looking forward to that. Are we sufficiently restrictive? Deutsche Bank's Matt Lazzetti does not think so. They moved their peak rate forecast for the Federal Reserve from 5.1%, Lisa, to 5.6%. A lot of people starting to think more and more about that upside risk to the terminal rate.
Deutsche Bank has been on the higher end of the terminal rate, and now perhaps they're still on the higher end, but they're perhaps less on the higher end than they used to be in terms of other people joining with them. If you take a look at what the market is pricing in, Fed funds futures are looking at a 5.3% Fed funds peak in July, and it only comes down to about 5.1% by the end of the year. So not only are we pricing at a higher terminal rate, but also we're seemingly pricing out to some degree some of those rate cuts that people were talking about
You were
before.
off the set yesterday, John, looking at your stock portfolio, and Lisa and I were talking with Ken Rogoff, and he is not sufficiently restrictive.
He doesn't think
he is not. He is not on the edge of Bullard, but he mints no words. Lisa, remind me, you asked the great question, and he's modeling out to 6%.
It was nuanced because on one hand,
he's an academic, of course it is.
Well, no, but this is the issue, right? He's basically saying you're seeing growth surprise to the upside and inflation surprise to the upside. What do you do with that? On one hand, yes, you want to take the terminal rate higher, but what's the rush? And that was his argument. He wants to get to perhaps even 6%, but really slowly.
This is a discovery process, in the words of Matt Lazzetti at Deutsche Bank. So there's two ways of looking at it. Either you believe in long and variable lags, and you think that the cumulative tightening of the last year hasn't hit yet, or you just don't think we've done enough. Now, if you're a policymaker confronting those two risks right now, Tom, is it still the case that you think the bigger risk is doing too little versus doing too much? We spoke to the Richmond Fed president yesterday, Mike McKee, and myself, and he essentially said he thinks the risk is still doing too little.
First of all, folks, go back and look. If you're in the game, folks, go back and look at the interview, because Ferro and McKee are asking from a different world each. And it made for a really interesting bargain. I thought it was fascinating with the conservative heritage of the Richmond Fed. I don't remember, I think it was you that brought the insight out, where he said he goes out to Chamber of Commerce's and people only talk about inflation. Does Global Wall Street get that? There's really no other topic for our listeners and viewers.
Without a doubt. Does the president, does the White House get that? I think they do. I think this is the number one issue in this country still, in this economy.
Right now, this is really the threat that you start to see inflation that reaccelerates in some of the areas that you had disinflated before. If you end up with a higher than expected inflation read with several prints consecutively, we're going to start talking about a very different Fed picture.
I wanted to save this story, but I think we should do it now.
I agree.
Lufthansa is kind of the corporate story of this morning. This is Europe's biggest airline, grounding
it's run
all
like
flights.
As a German watch.
Grounding all flights, and we were led to believe this morning it was due to IT problems. And then we found out in the last 30 minutes, these are headlines you just don't usually read. Lufthansa IT issues were caused by Deutsche Telekom cutting a cable because they were doing construction works in the Frankfurt region.
And
I mean, TK, that's unbelievable in 2023.
But why doesn't it happen more often? Think about the history.
Sure.
One of the first people that mentioned this to me, this is 20 years ago, was Professor Rogoff said to me, logistics in the world, the way we're all linked together, and one cable gets cut, oops.
Just getting another headline from Deutsche Telekom. They've already fixed 2 out of the 4 damaged cables. What happened to German efficiency?
Well,
What's
hashtag
this all
things
about?
you never want to have to say, that they're working to fix damaged cables in Germany. I'm not going to weigh in on German efficiency, but this is not exactly a good PR move for either Deutsche Telekom or Lufthansa.
Lufthansa aren't great at PR. Shall I tell you my Lufthansa story? I get trapped in Frankfurt airport for hours, maybe like 8 hours. I send them a message, complaining essentially that I'm stuck in your airport for 8 hours. Anyone who's been to Frankfurt airport knows that Frankfurt airport is boring. There is nothing to do. Do you know what they said back to me?
What?
We hope you enjoyed the airport. We hope you enjoyed the airport. That was Lufthansa PR.
I have a feeling that you did respond.
And did not fly Lufthansa again. Futures negative 1/3% on the S&P. To all of you who were going to fly Lufthansa this morning and through today, my thoughts are with you. Yields are unchanged on a 10-year, 373.59, euro dollar 107.19, Lisa, euro dollar negative 0.2%.
So in 2.5 hours, we do get retail sales in the United States for the month of January. How important is this going to be? Basically expected to come in a robust way. Still on an inflation-adjusted basis, what are we going to learn from this? The people do have discretionary spending. You're already seeing that in the numbers. The real questions still remain. In other words, how long is it going to take to really work down some of the excess savings from the pandemic, which a lot of people are saying still are out there. 11 a.m., former UN Ambassador Nikki Haley officially announcing, I guess. I'm not sure what the announcement was yesterday, but she's re-announcing her presidential bid in Charleston, South Carolina. A lot of discussion around whether she can win based on her demographic, the fact that she's a woman, that she's a minority. There's a lot of questions about what this will mean for within the Republican Party. But to me, the real question is the opening salvo of the contours of the Republican race will be really interesting front and center. 2 p.m., the Congressional Budget Office is issuing a budget and debt limit forecast. And Sean, I actually think this might be more interesting than it typically is, because we find out how much runway we have before we have to start really worrying about the debt ceiling.
2-year yesterday, through 460. Through 460 in yesterday's
461
session.
right now.
So the last time the 2-year was here, I think was back to October, November time. The last time the 2-year was here, the S&P 500 was at about 3,800. And right now it's something close to 4,100.
Yeah,
that's the disconnect at the moment, I think, for a lot of people.
Yeah.
We've had this big repricing in the front end of the yield curve. And the equity market, even yesterday, in yesterday's session, did nothing.
We don't have time to sit on that right now, but we should explore that across the morning towards retail sales. I mean, the 2s10s at negative 87 basis points. John, I'm not on the negative 100 beeps watch. Boy, I'm getting there quickly.
Getting closer. Marvin Lowe joins us now, Senior Global Macro Strategist at State Street. Marvin, we'll talk about the data, CPI yesterday, retail sales a little bit later, but can we start with the bond market? We've had this repricing of a 2-year yield higher, much, much higher. I think the low of the year was early February, something close to 4%, now 460. At the same time, Marvin, this equity market stayed pretty resilient. What do you make of that?
Yeah, so, again, the disconnect between what bonds have been saying and what risk assets have been saying. I would add that the repricing of the 2-year also had a fairly significant repricing at the long end. So while we're inverting the curve more, we're actually doing it with higher break-evens and higher real yields. And we haven't seen that phenomena since last summer. And I think that when you get that unhinging of both inflation expectations in an environment where views are that the Fed needs to be more aggressive, you've got a cauldron coming together where risk is, should be challenged much more than what we've seen since the beginning of the year.
Marvin, one of the ramifications of the repricing, as you put it, the repricing of short paper, the LIBOR measurements, and for that matter, T-bills.
For sure, it is the market coming to the conclusion that what the Fed has been saying is an appropriate view on how the economy is going to develop, if you will, and how inflation is going to develop. We're taking out cuts while we're adding in hikes, and that's again a dynamic which a couple of months ago was one of the things that drove risk assets higher. There's new information that's coming to the market. The bond market is incorporating that into its view, but risk assets are still kind of looking towards those green shoots, which seem smaller and smaller as we kind of get this new data. And we are in an every data point matters type of environment now.
Marvin, it's so easy to say the bond market is smart and the stock market is dumb and the stock market isn't aware of what the Fed is going to end up doing. But it's not that easy because the economy has been surprising to the upside. The facts have changed. How do you decipher how much of the rally is justified by better economic fundamentals versus the fear of what's to come from the Fed?
Yeah, you know what? There is so much data. The data is so volatile. For me, I pick the ones that, really are important in kind of this broad tightening that we're going through. And it's still inflation, front and center. We got new data, not only yesterday on that front, but we got the revisions, which really make the fourth quarter kind of disinflation, if you will, which, Chair Powell certainly talked about, nowhere near as aggressive as we had thought. So that's new data. And then, what's driving that inflation number? It really is the wage growth. It really is the jobs that are being created. And that's going to either, get affirmed with retail sales today, or, we'll have more data that gives the no landing or soft landing folks a little bit more runway. But, so far it does seem as if this hotter economy is driving consumption, which keeps the inflation discussion unbalanced.
And Marvin, given the incoming information of the last month or so, the terminal rate you have penciled in, have you put a line through it and priced it higher?
You know what? I had always thought the risk was, the risk was certainly that the market was underpricing even the dots, and we've erased that. The risk to me was always going to be potentially higher, and that this inflation story was a little bit more sticky. So that's evolving. I'm going to do it 25 basis points by 25 basis points. We are getting into restrictive territory. We are data by data dependent. And it's not as if all the data is saying that they need to go to 6%. The data is saying that it's improving so slowly that it might need to go higher. But, 5.5 at this point is what I would think the Fed would signal as a new dot when they meet again in March. And then we'll go from there as the data kind of comes in.
Marvin Lowe, Estate Street. Marvin, great to catch up. Some of the big issues at the moment in this market. Spare a thought from Marko Kolanovic over at JP Morgan, who's had a really tough time calling this market over the last year or so. He put out some research in the last month that said risks are shifting in the direction of higher DM terminal policy rates, and he was dead on. He was right, except it hasn't inflicted much damage on the equity market at all. So you can make that call, an accurate one, on higher DM terminal rates as we price in higher DM terminal rates looking at the Fed, but ultimately it hasn't inflicted the damage on the equity market as some people might have thought.
Because it's come on the heels of faster than expected growth and positioning that perhaps left people rethinking whether they really cared about getting out of big tech, which is really the big question. Why is that rallying in the face of higher terminal rates?
I know.
The most? This really, that defies logic to me.
TK, two head scratchers. The rally we've seen in tech year to date, Lisa's talked about some of the reasons behind it. And number two, I still hear just a sense of confusion from Fed officials around that jobs report from 2 Fridays ago.
I totally agree with the sense of confusion about the revisions and such, but on corporate America, I'm going to go back to theme one. They adapt, they adjust, they'll adapt to Ken Rogoff's 6% rate.
And what's the Fed? Fed's data dependent, TK.
They're massively data dependent.
Futures down 1/3 on the S&P. Gaga Chowdhury at BlackRock in the next hour. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The threat of more air and missile strikes remains across Ukraine as Russia attempts to gain full control over the Donetsk and Luhansk regions. Canada's defense minister reconfirmed NATO's support to Ukraine and called for Putin to leave the country.
If Putin wants this war to end, all he has to do is leave Ukraine. And that is exactly what the fact of the matter is. And until that occurs, we are going to be standing strongly with our Ukrainian counterparts.
Anand spoke exclusively to Bloomberg on the sidelines of NATO's defense ministers' meeting in Brussels. The UK isn't considering backdating pay raises for NHS staff and other key workers, according to a government official. The Financial Times reported Prime Minister Rishi Sunak and Chancellor of the Exchequer Jeremy Hunt are considering a pay offer that would see higher wages kick in from April this year, alongside a lump sum payment that would effectively backdate the pay increase to January. China warned today that it will retaliate against the U.S. over violations of its sovereignty, potentially escalating a lingering dispute just as both nations' foreign ministers plan to attend a security conference in Germany. China's foreign ministry spokesman claims the Chinese balloon down by a U.S. jet had inadvertently floated over the country after being blown off course. China insists that the balloon was a weather monitoring device. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
If it's If it's not a danger, then why'd they shoot these things down? They shot it down because they felt it was operating at an altitude that posed a threat to commercial aviation.
On the one hand, the administration is saying we don't yet know what these last three objects are, and we don't want to characterize until we recover them. But on the other hand, it wasn't a threat. Both of those things can't be true.
Bottom line is, I think the Biden administration is being very careful and very thoughtful.
The balloon saga continues. That was Senators Marco Rubio.
Give me an update,
Tom Cotton,
balloon guy.
Chuck
Give me an
Schumer.
update.
If you want the response from China, it reads a little something like this. This is from the Foreign Ministry spokesman. You'll love this quote. Try and translate this, Tom. China is strongly opposed to this and will take countermeasures against relevant US entities that have undermined our sovereignty. That piece of it's interesting. And security to firmly safeguard our sovereignty and legitimate rights and interests. What does that mean?
I have no...
Our sovereignty, our sovereignty over American airspace. That's new.
To me, on a serious note, it's got to eventually fold into Taiwan, and I know that the newly ascendant Republican House is making visits to Taiwan. Maybe that's the stew of the balloons and Pelosi-like visits by the other side.
Okay, on the margins, there are some discussions about who owns the ultra high space over a country, because it's, basically
okay, 40,000 feet.
80,000.
That's China's?
No, I'm not saying that that's true. But on the margins, there's a really peripheral kind of weak debate on that level. The more important conversation here is that China is trying to signal strength amidst a real bungling of a message that has become a very difficult place for the Chinese authorities to become.
Oh, it's totally embarrassing.
It's embarrassing.
It's highly embarrassing this last week, Tom, for the Chinese government.
Oh, yeah, huge. Oh, no, it's Stavridis, who I really lean on this, particularly with his international work with NATO, said this is a treasure trove of intelligence data that we will get.
What's amazing about this, Tom, is the aerial objects over the weekend still don't really know what they are.
Yeah, and I'm even hearing the dreaded word private, where, it could have been a party balloon from,
They're not party balloons, let's just be very clear.
Balloons?
But people are saying that they do not appear to be from China.
You've got the military shooting down things in American airspace.
Yeah.
And we don't know what they were.
Correct.
And it's kind of nuts, Tom.
I
mean, you can shake this off as balloon gate and laugh about it, but, it's pretty serious stuff.
It is. Let's migrate on to other topics in Washington.
Lisa's laughing about it.
Yeah.
Well, no, I think it's more the
Terry
aliens.
Haynes is laughing about it, too.
No, it's more that we basically have had a serious discussion about aliens with this administration. That is humorous.
A snapshot quickly to Edinburgh, Scotland, where Sturgeon is shocking Westminster and exiting. She is announcing a resignation. We're not going to go into the details of it, but we are going to go to Terry Haynes, founder of Pangea Policy in Washington. And Terry, I'm not going to mince words. Basically, my amateur take is the lady from Scotland is resigning because her party has had it with her. What do the various Republican candidates face with the devoted Trump party members along the path to November next year?
You've got, by the way, Tom, you've got two things going on with in the UK today. One, you've got Sturgeon, who's bumping up against, massive unpopularity, controversial policy, and inability to deal with independence. And you've also got Keir Starmer kicking the former leader Corbyn out.
Corbyn out. Yeah, I saw that.
And you've got, there's a similar kind of migration going on both in the Democratic and Republican Party here, where, Republicans, to your question, are trying to get past Trump, and they really have for the last couple of years. That's accelerating. You're starting to see, with Governor Haley and some other folks, poised to get into the race, how successful they'll be on that.
But
that
on a granular basis, in the voting booths of the primary, are Republicans in name only, as President Trump would call them, are they in for a rude awakening?
I think that largely depends on the quality of the candidates and, frankly, how many there are. It's generally forgotten that Trump had about a hard 30% in 2016, and he's probably got a little less than that today.
Interesting.
But there were so many other candidates that he ended up prevailing in a lot of primaries. If you coalesce around a Trump alternative, if you will, somebody with the positives and without the negatives, Trump could be upended rather easily, I think.
Terry, do you think the organization exists within the Republican Party to do that right now, or do you imagine this field's going to be massive by the time we get around to the primaries?
Well, I think two things, John. One is organization gives political parties too much credit, but there are clearly lots of efforts, both kind of on the political side and on the money side. You notice a lot of these large money networks that used to support Trump are now going elsewhere. And what you've got on top of that, frankly, is an ability to push a different kind of post-Trump narrative that appeals to a lot of people. So I think there's a lot of room here for alternatives. And a lot of these candidates, I think, frankly, are running for cabinet positions rather than presidency.
No, no, I'm shocked.
I know, shocker.
I'm shocked.
Well, but for whom, right? And for what party, right? Is this a party of the center that is moving more to the center, or is this really ultimately going to drive it back more to the edges simply because that is where the critical mass is?
Well, right, Lisa. Both political parties have the same problem, essentially, which is that, in order to get through the primaries, you need to appeal to kind of the core purists, if you will, and then in the general kind of move back towards the center. That problem doesn't go away this time, but what matters and what changes, I think, is the candidates and the quality of the candidates. You're going to see Haley getting in. You're going to see DeSantis getting in. You're probably going to see Senator Scott of South Carolina getting in. He was a very intriguing candidate. There'll be lots of post-Trump alternatives in the Republican Party.
To end where we began with Balloongate, there's one uniting feature with both Republicans and the Democrats, which is a hawkishness against China. And I wonder how much that desire to appear hawkish will prompt this relationship to spiral much lower, and what you're kind of expecting the contours of that discussion to look like.
Well, I think you were all correct a minute ago in talking about this being an embarrassment for China. It's not the United States' greatest hour either, since we've had lots of different explanations about balloons and how early we detected them and all that sort of thing. But there will be a desire to resume the cold peace here, I think. For markets, though, I think what this means is up defense stocks for quite some time.
Terry Haynes, I think that's the conclusion for a lot of people. Terry Haynes there of Pangea Policy on the latest with China and the Republican race heating up before the primaries even get started, Tom.
It's long. As I've said repeatedly,
said that a few times.
I yearn, but, here we are. We started. Who's next? I mean, I haven't seen within the zeitgeist the gaming of...
We know the names, DeSantis, Pence, take your pick, Pompeo
what
maybe.
What does DeSantis do? I mean, does he wait? Does he wait to see if President Trump jumps in and then I don't know.
Well, he is officially in, the former president, right?
Should
Donald
we do
Trump.
a Sunday talk show? Could you see us in here Sunday?
What would you like to talk about? Just football?
We could do English football.
Football blended with politics.
Really?
Nice.
Bramo on football.
So what else are you going to assign us? Where's our next road trip? And we're going to be here every Sunday.
Where are we
Anything
doing
else?
that show? Where's that
exactly.
happening?
That's
Well,
going to be in Capri.
I'm talking about, the scuttlebutt is there's an American looking at the tots and for just under $4 billion.
Iranian American, I saw that.
Yes, I saw that.
Yeah.
So we have to build up that. I mean, I don't want Mr. Levy to leave. We've got a great relationship with him, but I just can see us at some big game of the tots doing the broadcast.
We should form a consortium, Tom.
I don't want to talk to Harry.
Behind a bid.
Full disclosure, folks. I don't want to talk to Mr. Keene. I want to talk to Emerson Royale. I think he's just like lights out.
Are we talking about the score yesterday afternoon, or are we pretending that didn't happen?
How bad did they lose? Because they were just sort of like sleepwalking.
Yeah, I think Milan probably should have walked away 2-3-0.
Yeah.
But walked away 1-0 and go to
So
Spurs
is it
in a
over?
few
I don't
weeks'
know the
time.
rules. Are they
the
done?
Second leg's in a few weeks' time.
It's the second leg. They're legging in.
They're looking good, so to speak. I want to talk about Tesla briefly. The stock is positive by 0.7%. Production line upgrades are not unusual. This is the latest from Tesla. They will halt some production at its Shanghai factory until the end of February as it upgrades the facility to start rolling out a revamped version of the Model 3 in the Chinese market. Tom, this according to people familiar with the matter.
Can we talk inflation? Can we come back to that from yesterday?
You want to jump to that? Sure.
I did a really adult, fancy chart of New York City rents. And I won't go into the details, but it was very carefully done. If you take the decade 2009 to before the pandemic, we are 5 standard deviations out on a rent surge. I couldn't imagine that, let alone see it on the Bloomberg screen.
Since you pivoted back to that, are you moving? Is that on your agenda?
Well,
is that something that's high up on your list
we're trying
this
to
morning?
finally, we may expand out. I'm thinking 1,200 feet.
Oh, nice. Nice. To fit the whole family in.
As opposed to the studio.
Futures down 1/3 of 1% from New York. This is Bloomberg. Live from New York, equity futures backing away by a third of 1% on the S&P 500. Yields pushing through 460 in yesterday's session, and this equity market didn't budge. It was unchanged. That was a surprise for a lot of people. Equity futures come back down a third of 1% on the S&P. On the Nasdaq, down 0.4%. Your bond market looks a little something like this. Your 2-year in a basis point still at 460.54 on a 2-year. I mentioned this a little bit earlier, but the last time the 2-year was here, the S&P 500 was way south of where we are.
3,800?
About 3,800 on the S&P. The last time we were staring down the barrel of 460, 470 on a 2-year. So there you go. That's where we're at right now. This bond market confronting a chorus of Fed speak in the last 24 hours, pushing for more rate hikes. The Philadelphia Fed President Patrick Harker said, we're reaching a point where we'll have done enough. Tom, it's going to be above 5%. How much above 5? It's going to depend on a lot of what we're seeing. Retail sales, the next stop here, 2 hours away.
Yeah, there's a huge mix here. I thought the research report's off the inflation report. I think it's going to be the same here at 9 o'clock, 10 o'clock, 11 o'clock this morning off retail. Let's not mince words. Julian Emanuel working with Ed Hyman, and Mr. Hyman reaffirms 2.5% inflation by the end of the year. Is that suddenly an outlier?
What's the rate call that goes with that?
Don't know. Didn't read that far.
Okay.
You know,
well, that's kind of important. How high does the
well,
Fed
the
rate
rates
to go
with that.
to achieve that?
I mean, that means Ed's looking for a lower 10-year yield. I mean, is what it sums to me. But it's a jumble right now.
I couldn't agree more.
Yeah.
The sense I got speaking to the Richmond Fed President, Tom Barkin, yesterday, is there is still so much they don't know about this economy.
Well,
and they're kind of still feeling their way through it at the moment.
Well, it's original. It's off the pandemic, and that's the question: is what kind of inflation is it, and what kind of retail sales? We could get a combined Tuesday, Wednesday brief with Sarah House, senior economist at Wells Fargo. Sarah, link these two reports together. How do you, as a pro, link Inflation Tuesday with Retail Wednesday? How do you do that?
Right. So I think it comes down to what is happening in that demand environment. What is the consumer willing to spend, and how does that feed back through into the inflation dynamic? So we have seen disinflationary pressures begin to mount, and some of that's just supply chain dynamics unwinding, but a big portion of that too is what happens in terms of that consumer demand, particularly given the battle against inflation that real incomes have been under over the past year.
Are we in aggregate America? Wells Fargo's been acclaimed at this in your research for decades. When you look at inflation, or particularly looking at retail sales here in 2 hours, do we have a retail countdown clock?
We should get one.
We should get a retail count. Let's work on that. A retail countdown clock. Sarah, I'm fascinated by, do you aggregate retail sales, or are they polarized with the haves doing well and maybe the rest of America flat on their retail back?
Well, we still tend to look at retail sales in terms of the aggregate. Unfortunately, it's tough to get some of the more detailed look at how different consumer segments are doing. But I think you can tell by the different categories of retail sales how consumers are reacting. So, for example, when you adjust for inflation, we've seen spending at grocery sales decline a little bit, I think suggesting that those lower income consumers are getting squeezed. So I think there is still some parsing that you can do, but I think overall we're looking at a picture where consumer spending is losing momentum. So yes, we're going to get a pop, we think, in the retail sales number today, even on a real basis, but you have to look at what's been the trend over the past few months, and we ended the year with a pretty big dud. So two months of negative retail spending.
You've been out front on this, Sarah. You believe in a rapid disinflation despite some of the recent hiccups. How do you then look past what we saw yesterday and double down on this idea of a rapid decline in the inflation rate to a point this year?
Well, so I think we've actually been pretty conservative on how fast inflation is going to come down. So I think directionally we're optimistic that it is easing, but I don't think it's going to be quite as quick work as I think many were thinking, particularly after the December CPI report. So yes, you're seeing a lot of downward pressure when it comes to the goods side, particularly in the vehicle sector as the inventory recovers. You can see the shelter relief coming in sight over this coming year. there. But I think when we look at some of the underlying drivers, particularly when it comes to the labor market, that's actually going to make it difficult to get all the way back to 2% on a sustained basis. So it goes back to that discussion of the last mile, where we can get some quick improvement here in the near term, but getting all the way back to 2% and sticking that landing is going to be pretty tricky, considering you still have a lot of inflationary pressure emanating from the labor market.
I want to build on the last mile idea, which you have been out front on. But before we get there, I'm curious, have you increased your terminal rate expectation after yesterday's print?
So heading into even the January jobs report, so we were looking at a terminal rate of just over 5%, so between 5.25% for that target range. I think that was maybe looking like a little bit of a push, considering the deceleration in activity we saw in some of the November and December, both spending and production numbers. But I think with the data we've seen over the past couple weeks, not just the payrolls, but also the upward revisions to some of the inflation data, as well as yesterday's report, that's still looking like a pretty comfortable call. So I think we're feeling pretty good about where we are. There's a lot that can happen between now and the June meeting, which would imply perhaps even raising that terminal rate further. So we'll get another 4 employment report. So I think for now that's still a pretty good position, and we're comfortable with that 5.25% range right now.
Talking about the last mile, getting from 3.5% to 2% inflation, we had Ken Rogoff of Harvard University on yesterday, and he was basically saying the Fed is going to allow inflation to run hotter. The terminal rate will be higher than it has been in the past. Adam Posen saying the same thing. Do you hear a growing number of economists and thinkers pushing for this, saying it's not really that important to get all the way down to that last mile?
Well, I think we've seen the Fed, after the tremendous bout of inflation we've seen, they want to demonstrate their commitment to that 2% target, and especially even if you think of it on that average basis. Well, even accounting for the slow increase in inflation, where it was averaging below the 2% target, looking back even through the Great Recession, we've now averaged 2%, and so I think there's still that commitment to get it back down. But I think sure, you might see the Fed willing to live with 2.25%, 2.3% if the difference is really seeing the labor market fall apart.
Sarah, dumb question. Is Amazon in retail sales, the report this morning, and is it like a big deal, or is it just a smaller number?
No, it's in there, and it's a pretty big deal. So that shows up in the non-store retailers, and you can really see some of their activities move the overall numbers around. So, for example, when you have Prime Day, or the timing of Prime Day shifts, and the seasonals are having trouble keeping up with it, you can really see it in that non-store segment. So it is absolutely in there.
I mean, I look at what we saw. Liz Young had out the great chart showing shelter is well in food. Is food in retail sales?
Yeah, so food's in there in 2 places. So one, you get the grocery stores, and so you can see what that cost of food at home is. But the one services side that we get a glimpse at in today's retail spending report is what happens at your food services and drinking establishments. So you do get some hint at what's happening with some of that discretionary services spending, but also you do have to think about what's happening on the inflation side there, just given how much labor costs and well as the food input costs have grown over the past year.
So what do you forecast for that?
So we don't get quite that far into the weeds in terms of that specific one, but you did see another pretty big jump in terms of the inflation rate for food away from home. So you're going to have to take whatever change we get with that and discount it by basically 0.6% to get what's the real services spending signal that we're getting from the retail sales report.
This is key data.
I understand.
This is key data.
You've got some key insight on it.
I do.
We have
ample forecast.
You've moved the dial.
I think it's really interesting, and
Sure.
I mean, what Sarah's tearing apart there is the two worlds of, anecdotally, people are telling me it's a crazy boom economy. The restaurants are packed and all.
Yeah.
And Paul Ajuz at Citigroup publishes this morning saying their charge card sales for a window of January, February were as grim as they were in early November.
Oh, that's interesting.
I don't, that's
Bank
why
of
I
America's
asked.
card data was great.
Yeah, I don't.
MasterCard as well.
Yeah,
Interesting.
It's a jumble.
Sarah House of Wells Fargo. Sarah, thank you. Bank of America looking for a really punchy number off the back of that card spending data.
Yeah.
They're looking for 2.6% month-over-month spike in core control sales. That's
Headline,
a big figure.
Headline, Lufthansa, they paid their bill to Deutsche Telekom.
Some flight operations have restarted. All Frankfurt flights remain grounded. I mean, this is kind of nuts. isn't it? So if you're just tuning in, earlier on today, the German carrier Lufthansa, which incidentally is the biggest carrier in Europe, had to ground all flights. They later explained the IT system outage was caused by Deutsche Telekom cutting a cable doing construction works in the Frankfurt area. Tom, they expect the IT problem to be resolved in the early evening. So the latest update, some flight operations have restarted, but all Frankfurt flights remain grounded. Not a great start to the week for this company.
Can I give you my Frankfurt story? You had a great
please.
one earlier.
I shared mine. You share yours.
I land, and I'm late to the ECB as they're opening to see Ottmar Issing, who's a giant in economics. It was such an honor to spend 2 days with Dr. Issing, and we've done some other things for Bloomberg over the years. So I get in the car, John, and I am the American tourist.
What did you say?
The guy's in a Mercedes taxi cab or whatever. I go, I'm late to the ECB. Can you get me there fast? I look out the Autobahn or whatever, that I've never seen the trees go by that fast.
He really put his foot down.
I think he was going 110.
Oh, really?
Know. Oh, they were flying.
Wow.
The whole German flying.
No speed limit, Bramo. What were you like?
Can I say, I actually think this is a fascinating story from a larger perspective as well, because we've been talking about the revenge of the real economy, the revenge of the real industrial world. And we're so hinged on all of the data that we can transmit infinitesimally in seconds through these fiber cables. And then there are actually people who have to lay them down, and they're physical cables. And if they get cut, our world as we know it ends. And it's sort of that sort of dissonance which is leaving a lot of pitfalls and the lack of investment in that physicality.
You had to darken the mood with something serious, didn't you? Yeah, I know. Deadly serious stuff. I agree. We're going to talk about it next, and you can have that conversation. Terry Wiseman's going to join us at 8:30 Eastern Time as well.
Good.
On rates, current season, the latest retail sales. The latest from Mohamed Al-Arian. He says this, it's far from over, Tom. The lead is meagre for AC Milan, having to travel to London for the second leg. Bottom line,
I didn't know that.
Mr. Ferro should be as worried as you. It's lovely to hear from Mohamed, not talk about the economy or the Fed, but try and throw mud at my dear
Can I
AC
ask a
Milan.
question to his beloved Queen's Park's Rangers of Shepherd's Bush?
QPR, yeah.
Are they in the Champions League running?
No, they're not.
It's just Premier League and the bigger teams.
They're in the lower leagues.
So this is sort of like a Super League try.
Kinda.
Kinda.
But not really.
Okay.
If is that a dig at QPR at the same time?
No, I would never do that.
Mohammed's going to love that.
Mohammed wants us to do the show from QPR.
Does he really?
Yeah, he'd come down.
That'd be nice.
Shepherd's Bush, the whole thing.
You've been to that stadium before?
No, I have not
Nice
been to the
stadium.
stadium.
Nice
but,
stadium.
they play Richmond here in season 3, and it'll be interesting to see QPR.
Of course.
Yeah, Richmond went down.
Yeah, of course.
They believe.
This is all about Ted Lasso.
Yes.
I forget. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. European Commission President Ursula von der Leyen says the European Union's new sanctions package would target $11 billion worth of goods via trade bans and technology used in drones, missiles, and helicopters. Draft proposals seen by Bloomberg show the EU is poised to force banks to report information on Russian central bank assets as part of the bloc's latest sanctions package targeting Moscow for its war in Ukraine. A flurry of volatility in the final 3 months of the year wasn't enough for Barclays traders who missed estimates in both fixed income and equities in the fourth quarter, sending the bank's shares down. Shares fall more than 8% at the start of trading in London. And as you've heard here on Surveillance, Lufthansa Airlines has grounded all Frankfurt flights because of a company computer issue. Now, a spokesman says the company is urgently investigating. A person familiar with the matter tells Bloomberg the IT issues were likely caused by Deutsche Telekom cutting a broadband cable. Now, in total, the group operates around 700 aircrafts, making it Europe's largest airline by fleet size. And a new lawsuit accuses venture capital and private equity firms, including Sequoia Capital, Thoma Bravo, and Paradigm, of hyping the legitimacy of FTX. That's a crypto exchange that collapsed, causing billions of dollars in losses. According to the complaint, the firms participated in a marketing campaign to tout their own investments of hundreds of millions of dollars in FTX entities, adding, quote, an air of legitimacy to the enterprise. Global news powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
We may or may not choose to take rates up further if inflation continues to persist, but we'll have to see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists at levels well above our target, maybe we'll have to do more. The biggest surprise has been the jobs market.
Without a doubt, that's been the big surprise. A special thanks to the Richmond Fed for a 20-minute interview with the Fed President Thomas Parkin. Very generous, very gracious with their time. And the similar story across all Fed speakers yesterday. They believe they've got more work to do. I think they've all been surprised by the jobs market, as have we. And there is this push now for a higher peak rate at the Federal Reserve. The next stop for that debate, as I say, 8:30 Eastern Time, about an hour and 43 minutes away with retail sales in America. Just to set things up on the price action for you briefly, equity futures down about 0.4% on the S&P. Yields in the bond market look like this, unchanged at 4.61 on a 2-year. That's going to take some getting used to, considering a couple of Fridays ago we were talking about maybe breaking down into the threes, but there you go. On a 10-year, down about a basis point to 373 on a 10-year. Let's call it 374 right now. Dollar weakness, I thought was really interesting. The dollar weakness we've seen over the last couple of months hasn't really corrected in a major way, even with the push higher in yields. Take yesterday as an example. So yesterday we had a big push higher, Lisa, in yields on a 2-year. The equity market didn't budge, it was unchanged, and the dollar didn't really do anything either. What do you make of that? Is that a disconnect right now between bonds and pretty much everything else?
The only disconnect here is that the dollar used to always rally disproportionately in response to Fed rate hikes, but now the ECB is doing the same thing. And the data's coming in, and you're seeing better than expected data coming out of the Euro region as well. So both sides of the Atlantic facing the same issue that might leave terminal rates globally a bit higher than people previously expected.
And I guess that's the change, Lisa, and it's an important one. Dollar a little bit stronger, DXY up by 1/3%. The biggest corporate story of the morning, Lufthansa. This is Europe's biggest carrier, grounding all flights briefly because they had a computer system failure because Deutsche Telekom cut a cable. The latest, Tom, all Frankfurt flights remain grounded. Some flight operations have restarted. They expect the problem to be resolved in the early evening.
We'll see. I mean, they're going to get it fixed, and it does harken. And I think Bloomberg had a nice summary yesterday of the pickup from the software issues that we had in the United States a number of weeks ago.
Have they been explained yet, Tom?
No, I don't think they've been explained, but at least it's something that we're following on with. We're going to get a brief here from Berlin. To me, what is really a mystery airline, Lufthansa. Chad Thomas joins us right now from Berlin. Chad, I think there's a wide understanding in America and our viewers and listeners that Air France has a massive French, maybe Dutch KLM linkage ownership as well. Is it correct that Lufthansa now is all private and the German government has stepped away?
Good morning, Tom. Yeah, the German government has stepped away from Lufthansa. They of course had stepped into the airline during the pandemic, but they have paid back that money. Of course, what we've seen play out here today, this morning here in Germany, has been quite an eventful turn of events with this cable that was cut by, is actually, we've now learned, by the German National Railway. They were doing some work and they cut a Deutsche Telekom cable, which basically grounded the entire Lufthansa fleet. As a reminder, Lufthansa isn't just the Lufthansa brand, but it's Swiss and Brussels Airlines and Austrian as well. So this has really had an effect across air travel in Europe this entire morning.
Chad, we've heard a lot about some of the strikes, some of the labor disputes within Lufthansa and beyond in the industrial complex in Germany, throughout Europe. Does that connect at all to this sort of tussle over power between labor and the employers?
Well, this certainly adds to Lufthansa's woes, Lisa. They are dealing with a lot of labor unrest, as are many companies across Europe. There was a strike, for example, at the Berlin airport a couple of weeks ago that shut down the entire airport for a day. There's potentially more strikes coming at Lufthansa on the horizon. So all of these things just sort of adding to the chaos for travelers here, really, in Europe as they try to get from point A to point B.
What's behind that? Are there just not sufficient bodies to take the jobs? Is it just growing unrest after years of feeling an inequity in terms of who's gotten the pay, or some broader social issue?
I think a big part of it is just the really high inflation you're seeing here. You also have really strong labor unions in Germany, so they're willing to really push things to the edge to try and force the Lufthansa and quite honestly other companies to raise salaries by quite significant amounts. So you have the combination of the inflation and also just the strong labor unions here.
Hey, Chad, we've all read those articles about the UK in decline. Do we need to edit them and just replace the UK with Germany? I mean, the last year or so, they've been exposed on the energy relationship. They're totally exposed on the relationship with the Chinese government when the United States is trying to do something about that. And it just seems to me that these stories aren't popping up from nowhere. Chad, what do you make of that?
Yeah, I think, John, one of the things that everyone is going to be looking at is sort of reassessing the time of Angela Merkel's chancellorship. I think that many people looking back on it now will say that she should have taken more action when it comes to the relationships with Russia, with China, and of course, Germany is really behind when it comes to digitalization. In a way, it's kind of humorous, if you will, that this failure at Lufthansa today is because of a cut of a broadband cable in the Frankfurt area, when this is something that is known in Germany that the country just really lags behind. So I do think we're going to see a reassessment of Angela Merkel's time as chancellor and how that's going to play out in the coming years in the German economy.
I agree. I think there was always a sense that maybe the history books wouldn't judge it too well. Chad Thomas of Bloomberg, thank you, sir, as always. Always got the sense, covering Europe for a while, Tom, that Chancellor Merkel was given a bit of an easy ride. I understood she faced very, very difficult issues, but the legacy is about what happens in the 10 years after you leave off the policies that you set in place.
Yeah.
There was a massive opportunity to do infrastructure spending. It was on a plate. We were talking about negative rates for the best part of a decade. And meanwhile, the finance ministry every single year would celebrate the so-called black zero. No budget deficit. And I always found that really, really, really strange.
The trap for me, and I think for most Americans, is we always look at it through some form of greater European or even international prism. And my question is, how much of a slave was she or Willy Brandt or the rest of them, Schroeder and the rest, just completely beholden to the domestic politics of Germany, which was that zero budgeting and that caution?
Well, there was always a feeling that that government just was riding the wave of the Schroeder reforms from the previous government.
Exactly.
And now this government's got to face the consequences of what didn't happen in the previous government led by Merkel. And there are many, many issues right now. And we've talked about it a million times, Lisa. Every time a foreign policy expert comes on and they talk about the two major issues that the United States is facing abroad, one is Russia and the other is the Chinese Communist Party. In the middle of that is Germany compromising each and every effort repeatedly and for much of the last decade.
And to your point, Olaf Scholz is between a rock and a hard place in terms of how he deals with that, because right now, if Germany were to extricate itself from its relationship with China, it would go into a deep and painful recession because of its dependency on the revenues from there. So that's not really an option to make some sort of hard break. On the flip side, how do you invest in infrastructure now with an inflation problem, with borrowing costs at the highest levels they've been since the financial crisis? So it's an incredibly fraught moment for someone who is picking up the pieces after a pretty calm period.
Part of the Merkel free lunch was a euro, and that the manufacturing powerhouse Germany, and I'll let David Folkerts-Landau and George Saravelis at Deutsche Bank explain this, but the answer is that a 107 euro, maybe a Deutsche Mark would be an equivalent 115 or 120 stronger euro, tougher export environment for Germany with a legit Deutsche Mark. And so they sort of get a free ride with weaker euro because, to use the stereotype, Greece or Italy are screwing up or AC Milan is screwing up, one of the three.
It was always Milan's fault.
Yes, it was Milan's fault.
No, but Tom, we talked about that so many times. The pain on the periphery, in some sense, and not completely, but in some sense, benefited Germany. A weaker euro,
and
lower
Rogoff,
bond yields repeatedly.
To go back to the giant Ken Rogoff, he was heated yesterday of the advantage we have in our flexibility here because dollar is the sovereign currency. He was heated.
The weak spot in the Eurozone now, Germany. We talked about Italy, Spain, Portugal, and Ireland for a long, long time. It's Germany and has been for the last year.
Yeah, I would say the center tendency, Netherlands, Germany, and that. And to me, it's the inflation of 10.1% in the United Kingdom. Okay, that's emotional.
Yeah.
They'll figure it out in an Anglo-Saxon way. Guess what? Germany's 9%. Culturally, that is impossible in Germany.
Well, they got bailed out by the weather this winter. That's for sure. Equity futures right now down 0.4%. The next stop for this market, retail sales data in America. It is 1 hour and 34 minutes away, and we're trying to put that clock together, Tom. We'll try and make that happen for you. A countdown clock for retail sales.
Do we get a
data
PPI
on
countdown
Wednesday.
tomorrow?
We can do that for you if you want. Isn't it Jobless Claims Thursday?
PPI?
Claims Thursday? You want it to be PPI Thursday?
I think so.
Just for you, Lisa. We'll make it happen.
The Fed doesn't just have to figure out how much is inflation. They have to figure out where do we put the interest rate long term.
Are there more hikes to come? How do they comment inflation? And we have seen that the Fed speak has been moving markets.
Equities and rates, they are still working in a way paired off, like teeter-tottering like they're supposed to.
If the economy is not in recession and inflation is in the 3 to 4% range, you're not getting a Fed that's easing.
It feels like to me that the Fed has really almost locked in a game plan here. They want to get rates just above 5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Retail sales data in America 90 minutes away, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Equity futures down 1/3% on the S&P. In yesterday's session, totally unchanged on the S&P 500, even in the face of much, much higher bond yields, Tom. Your 2-year through 460.
I'm seeing across the zeitgeist this morning a lot of not looking at the market. I think we have to look at the market as we go 90 minutes out to retail. I'm going to go right to 210 spread at negative 87 basis points. It seems like we've gotten a third of the way to 100 basis points in about 2 cups of coffee.
I keep going back to that Neil Dutta line of Renaissance Macro. Turned around yesterday, Bramo, and he just said, forget high for longer. They need to get higher. And Deutsche Bank agreed. Matt Lazzetti taking a terminal rate over there now. Their estimate, 560.
A lot of people agreed. You saw this pretty much across the board with Fed funds rates really repricing in terms of what's expected for later this year. The tension here is this time different? Can you get a no landing with an inverted yield curve that's the most inverted going back to the early 1980s? Can you get a soft landing or a no landing with a Fed that has to do that much more without us understanding the consequences? This, to me, is the question at a time when people are heralding some of the better economic data and saying it's still a green light to go into risk.
Well, off the back of that question, Tom, you've got to answer this one. Do you believe in long and variable lags? Do you think we just haven't seen the damage yet from the policy move of the last year?
First of all, we got to get the retail clock up. I mean, we got to get that's going to be a long and variable lag to 8:30. But to me, the long and variable lag is our data dependency, and I believe there's an inflation report before the March 22 Fed.
There is. You get some more information.
I'm sorry, that will be. It's more key than it was on Monday. That's how I'd put it.
I'll bring you the full quote from Neil. After more than 400 basis points of hikes in the federal funds rate, all the Fed has to show for it is the S&P 500 15% off its lows, the unemployment rate at 3.4%, and underlying inflation still running hot. And Lisa, I go back to that question. Do you believe in long and variable lags, or do you just believe this Fed hasn't done enough?
Especially because, by many metrics, financial conditions have eased to the easiest going back to early last year. I mean, this, to me, is the conundrum that Neil is really highlighting. They are not transmitting their policy through markets. Are they transmitting it through some of the other functioning, particularly with respect to the housing market? And is it enough? And a lot of people are saying no.
Well, look at the home builders. They're up almost 60% from the lows of last year. The lows of last year were like in the summer, in the middle of the year.
Exactly.
Corporations adapt. I just randomly picked General Mills because we were talking Lucky Charms this morning. I don't know if they make them, but like any consumer goods, like Coca-Cola yesterday, revenue growth Q4 last year 8.1%, modeling out 4%, maybe even 7% revenue growth. I mean, people this OMG rates are going up is just dead wrong based on my ute.
Did you eat Lucky Charms?
No, I did not. I did not eat Lucky Charms, but other members of our
every morning.
Yeah, for a long time.
Just sort of like running around the room afterwards.
I
off the walls.
I would eat the oat part first and let the marshmallows sit there so they would really soak up and get soft.
Some strategic.
It was strategic Lucky Charms eating.
Some strategy. Yeah. I like that. We imported them once in the UK. I had them for breakfast once, and that didn't work out, and it never happened again. The box got put away, and I never saw it.
Do you know?
I think my mum told me they don't make them anymore.
Do you know how scarred my childhood was?
Go on.
I didn't know until I went to college that Raisin Bran could be eaten because we were told it was an adult cereal, so we wouldn't eat it. I kid you not.
It was just for
It
adults.
was just for adults. You can't have a Raisin Bran.
Wasn't it marketed just towards adults? I think it was. It wasn't for kids.
It was a scourge.
It was just for adults. You can tell us more about it. We'll do a therapy session, Tom, in the next
We're
news
vulnerable.
conference at the Fed.
We're
Futures
just
right now, down a third of 1% on the S&P. Let's whip through it for you. Yields higher in yesterday's session, particularly at the front end of the bond yield curve. We're looking at yields right now unchanged, Lisa. On a 10-year, let's call it 375.
What we're watching today is really in 90 minutes' time that January U.S. retail sales coming out at 8:30 a.m. The expectation is for a month-over-month increase of 2%. And basically, this is strength that is on a real basis. Will it really move the needle since it is largely expected? This is the question heading into tomorrow's PPI and jobless claims. 11 a.m., former UN Ambassador Nikki Haley is speaking perhaps again about her presidential bid, which was officially announced, I guess, yesterday, but now discussed in Charleston, South Carolina. We'll be talking all about that coming up on the show. And at 2 p.m., we get the Congressional Budget Office issuing a budget and debt limit forecast. And John, we haven't talked about this a lot, but I actually think it's going to be important. If they tell you the deadline is June, people will say, great, I don't have to think about it until May, basically 15th.
Or June.
Or June. That's basically my takeaway.
Do you want the good news? The clock is up. 1 hour, 24 minutes and 40 seconds away from retail sales in America.
Oh, that was this for. I
There
thought
we
that
go.
was to,
No,
for,
the clock
for me
is
to
up.
start shopping to catch up on Valentine's Day.
Oh, there we go.
I thought that's what the
Roses
clock
on
was
sale.
for.
Love that. Gargi Chowdhury of BlackRock alongside us in the studio. Gargi, thanks for being with us. Neil Dutter of Renaissance Macro sat in your seat to close out last year, and he brought up the prospect of a so-called no landing in this economy. Torsten Slock has built on that of Apollo in the last couple of weeks, and he just published moments ago. He said he thinks markets are pricing the no landing scenario. There's more and more signs of the market pricing in the no landing scenario where the economy remains strong and inflation remains sticky and persistent. Are you on that side? Are you in that camp?
Good morning. Good to be here. So I'll start by saying I did listen to Neil and Torsten as well. And I think that there are some good points that they're making. Obviously, so far, that the data that we've seen from the services side of the economy has been strong, labor markets especially. But I think it's still too early. We have seen a lot of damage on the manufacturing side of the economy. We look at small business optimism. That's obviously declining as well. We look at confidence. That's low. So if you look across a variety of spectrum, across the spectrum of a variety of data, I think that for now, it's too early to say that there won't be any kind of landing, that the economy is flying. What I will say is it's possible that this recession is delayed. So if you were in the camp that we're going to have a slowdown or a negative growth in the second and third quarter, perhaps now we're going to price in, and perhaps that's what the market is doing, that we see it in the third and fourth quarter. So it could be a recession delayed, but it's still too early for us to know if it's completely a recession that's not going to happen.
You got to respect someone who quotes Miles Davis within their research note. That's always a good thing. You talk about the blue mood to come, and you talk about the fake out from this warm weather to the consumer. And I'm going to go right to my childhood, which was blizzards in March. The blizzard is coming in March of 2023. Can you predict it, or is it just out there?
I don't think we can predict it. So the conversation we were having earlier was just around this amazing weather we're having in New York City. And I likened it to the equity market, where we can't take the last couple of days of weather or market participation and project it out. I think earnings growth at 3% for the next 12 months still looks quite optimistic. We were talking earlier about this long and variable lag of monetary policy. We're still going to get at least 2 more rate hikes from the Fed. Inflation, obviously, we saw yesterday remains sticky. I think it's too early for us to expect equity markets to have begun a new leg. We've seen this before. I think we're going to see earnings come down. I don't think, especially the growthier parts, if you look at what NASDAQ has been doing, I certainly don't think that this is the beginning of a new cycle. There has to be a reprice lower.
How much conviction do you have in this to basically lean against what we've seen in the past, 60 days or 45 days of this year? Can you basically say we're getting out of all tech stocks, we're going fully into T-bills, and that's it?
I don't think one should ever get out of everything. I think remaining invested has taught us again and again is the North Star. But I will say that as of right now, looking across what yields we're getting in the very front end of the fixed income markets, if you own ICSH, which basically gives you over 4.6% yield. That makes a lot of sense, especially if you think there is still data softening to come. And where in the equity markets you're placed is going to be very important. So I think any kind of equities that need real rates to be low/negative are going to suffer. We haven't seen that this year because the rally has mostly been an unwind of the sell-off last year. I'll also say that there's a tremendous amount of cash on the sidelines, and some of this rally is chasing. It's the FOMO rally, which we're familiar with from last summer. And the money that's on the sidelines chasing the equity market, especially the growthier parts of the equity market that did so poorly, there has to be a reckoning of some sort. So I say stick to high quality fixed income for now. Think about bonds as regaining some of their ballast, especially as we see over 375 in 10-year treasuries, and stay invested, but perhaps in the value parts of the market.
Just real quick here, as I was sitting last night, just worrying, because that's what I like to do, I was thinking about this rush into cash and the disruption. Tom just can't get over that, of possible debt ceiling debate. Could you see a disruption in the cash play because suddenly people start realizing on June 1st that the debt ceiling debate is going to become a real thing?
Absolutely. So when we get nearer, when we know when the X date is, we've seen this every single time in the past, there's obviously going to be some mispricing in the bill yields, for sure. I think that's something that is going to happen. We're going to see that spike. Obviously, once the debt ceiling gets resolved, we're going to see that come back. But for now, I think that is still something that could be between June and August. I think that investors should still be in the front end, 2-year treasuries, 3-year treasuries, or even 2-year IG, and clip your carry. Clip about 5%, 5.5% coupon.
Take the income and walk away.
Yeah.
Make it easy. You get paid to wait. Dan Scally said the same thing over at Morgan Stanley this week, Tom. You get paid to wait.
Yeah, I'm hearing that, and there's some real validity to that. There's, Reminiscence of a Stock Operator, which is a classic book everyone should read every 5 years so they don't lose money. And there's a point in it where you do nothing, and the hardest thing is to do nothing.
Oh, especially when you see these numbers. I was making notes of it last night. United up 33%, American Airlines up 32%, Delta up more than 17%. You look at Meta up almost 50%, Tesla up 70%, Apple up almost 20%. They're year-to-date moves. Year-to-date. Well, yeah, it's hard to sit that out because someone's saying get 5%, lock it in for 2 years, and you see these moves playing out.
Retail or institutional, Gargi, and I'm sorry, to me it's really, really hard to do nothing.
Well, it's not doing nothing. It's just not getting bullied by the rally that we've seen so far in the markets and doing something as a result of that. So if the fundamentals make sense to you, if looking at tech and it trading 45% above its 10-year average on PE, if that makes sense to you fundamentally in a positive 2% real rate environment, then absolutely do something. It just doesn't make that much sense to me. But I think fixed income markets obviously make a lot more sense. We've talked about bonds being back as a ballast in your portfolio. That's where you should be allocating.
Hey, Gargi, thank you. Great to have you in the studio as well. Let's do this again soon. Gargi Chaudhry there of BlackRock. Futures down 0.2% from New York. Retail sales 1 hour, 17 minutes and 45 seconds away.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Turkish stocks soared on their return from a week-long suspension after authorities threw their full weight behind investors. The Borsa Istanbul 100 index rose, outperforming all other major world markets, and is headed for the biggest single-day advance since 2008. Turkish authorities suspended trading on February 8th and canceled trades made that day after 2 earthquakes hit parts of Turkey and Syria, killing more than 40,000 people. Scottish First Minister Nicola Sturgeon resigned after more than 8 years as head of the country's government and independence movement. Sturgeon has headed the semi-autonomous administration in Edinburgh since 2014. The decision to step down comes after an unusually turbulent time for Sturgeon and leaves her Scottish National Party and the independence campaign looking for a new figurehead without a clear roadmap. Ray Dalio, the former founder of hedge fund Bridgewater Associates, says China is coming out on top in the trade war with the U.S., adding the standoff between the world's 2 biggest economies likely won't escalate into military conflict. The billionaire investor told a conference in Dubai today that the real winners of the confrontation will be those able to tap into both the U.S. and China. Washington and Beijing have clashed on issues, including human rights, trade, and competition for technology and markets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
This economic catastrophe is entirely preventable. The solution is simple. Congress must vote to raise or suspend the debt limit, and it should do so without conditions. Let's not wait until the last minute. It is a basic responsibility of our nation's leaders to get this done.
Janet Yellen there, the US Treasury Secretary, is going to have some company. When does Brainerd join her? A couple of weeks. I'm trying to work that out quickly.
In a couple of weeks.
She has been named as the director of the National Economic Council, so there is a void now on the Federal Reserve. I'm told by the team it is late February, so maybe in the next week or so.
So the real question now is who replaces her? How quickly can they get someone in there, considering that she was really considered part of the brain trust on the group? I heard Seth Carpenter was named. Yes, he was actually.
I did not know that.
He was named in a Wall Street Journal
so
article.
So we have to be nice to him if we interview him?
Didn't we do this last time with Seth? We were nice to him because we thought he might end up on the Fed, and then he didn't. So we just rude to him again.
Great.
So we're nice to Seth again. Is that what you're saying?
Oh my goodness! Lots of other people too.
I'm glad you bring this.
I'm just going to go past that completely.
I'm glad you bring this up. I'm going to go to it, but there's a guy named Hans Nichols over at Axios. I don't know.
Don't know him. Who's that?
Don't know him, but Hans was on fire last night writing this up. I didn't realize Hans is giving credit to Deese, who I thought got better and better every month in the job of really getting through a lot of the domestic legislation. Will Brainerd do that? Is Brainerd going to be up on Capitol Hill counting votes from West Virginia?
You've got to coordinate policy. Absolutely.
Yeah.
You've got to coordinate policy. I'm not sure if she's vote counting, but you've got to coordinate policy across government.
Because I would suggest maybe in the history of all this, there's not a wider disparity from the gentleman, Mr. Deese, and the gentlelady Brainerd.
Well, to your point, though, Tom, she's got a ton of experience.
Oh, yeah.
In Washington and government, in Treasury over, like 20 years? A 20-year span?
Oh no.
In Washington?
Oh, no.
Longer?
Yeah. 25. Yeah. I mean, she, coming out of MIT.
It's not going to be new to it. The surprise for me is it just happened very quickly. I'm not surprised it's Lael Brainerd. We saw her linked with a Treasury job when Biden got into the White House. So this is totally unsurprising, but it's happened very quickly.
And it happens at a pivotal point for the Federal Reserve. And that, I think, is really an important point. I do think, though, speaking to Brian Deese and his domestic prowess, she will bring the international prowess, this sort of question about international trade and policy and how that dovetails into the U.S. economy.
Should we get a wrap of the markets quickly, Tom?
Yes, please. Excuse me. Lost my head there. I was distracted by the retail clock, 1 hour, 11 minutes, 25 seconds till I start my Valentine's Day shopping.
Love that.
Thank you.
Are the roses on sale yet? Yeah. No?
No. We're not going there. We're going for a more multiple statement.
So basically you're not going to pay for roses, even though they're on sale. OK. Futures down 0.2 on the S&P. Yields unchanged at 375 on a 2-year. I'll make this brief. Your 2-year yield this morning through 460 again after getting that print yesterday, 462. Are you telling me that's what you do on Valentine's Day?
I don't know what I do.
You get them to take the roses out to make the whole thing cheaper?
No. I just we just do lovely, beautiful equatorial flowers.
Oh, nice. Like leaves,
it's
branches.
It's like a statement, Yeah. It's
just
a statement.
Make it big, but
cheap.
Yeah,
but it can't be too big because with a 6th floor walk up, you can't carry it up the stairs.
I want big but cheap. Yeah. And they're like, yeah. We know your type.
Here comes Keene.
Henrietta Trey's about ready to walk away from the microphone, and she joins us. She was on fire the last time she was with us with Veda Partners. Henrietta, we talk about it as an executive position with the vice chairman maybe wandering over to the White House. I guess we're going to see that as well. Explain how the NEC advisor works with Capitol Hill.
It's a critical role, and you can remember that from everything involving the 2017 tax bill. Larry Kudlow, if I'm not mistaken, was NEC advisor at the time, and he was on the Hill quite a lot. And then after that, you had a big role to play also with the trade war and all the discussions about the tariffs. So you were mentioning the international component. I think that's going to be a really big part of her job as we enter this new role. I think that her level of respect across the Capitol is pretty widely spread. So I imagine it'll be met with a lot of enthusiasm.
I mentioned Brainerd, that I wrote Brainerd Reichert from a million years ago, which I had the clearest memory of reading when she was just out of MIT. And the basic idea is she was looking and studying American multinationals and the trade and labor dynamics. In your world, is it still like the 80s or the 90s where we're worried about losing jobs to China, or is that history?
I think that's a huge part of not just the talking points that you hear, especially from the president, but also a big component of the legislation that they're passing. I got asked this question yesterday by investors, do you have to pay attention to the restrictions that we're putting on China, say with semiconductors or batteries, or focus more on the nearshoring and the friendshoring and the bringing of manufacturing jobs back to the U.S. and providing, $72 billion just from the CHIPS Act for domestic manufacture. It's a combination of both, no question, and you have to be able to walk and chew gum at the same time with those.
Henrietta, Lael Brainerd is broadly respected, and a lot of people say she'll bring an incredible amount of experience and intellectual heft to this office. Now, who replaces her, though, on the Federal Reserve? How important is that for them to get a nominee in there and quickly, especially based on the difficult situation that the central bank is in right now?
I think it's the key question. It's going to take a while, I imagine. You have to think of the whole legislative agenda items right now. There's really nothing until the debt ceiling, the Farm Bill, and the continuing resolution, which I believe will be a September event, late September event. So you really have this Federal Reserve opening that's going to create the opportunity for hearings, for members to put holds on for whatever reason. We saw that a lot in the end of last year. With various Defense Department officials. I imagine it's going to be pretty complicated, highly controversial. Republicans are going to have a lot of reason to find opposition and flaws with whomever the candidate is. And that'll probably lead President Biden to tack to the center as much as possible. He obviously is very experienced when it comes to getting nominees through. He's got great Sherpas, and I imagine this will be a pretty heavy lift no matter who they try to get in there. And all the Republican presidential candidates are now coming out of the woodwork. People are going to have a lot to say about whomever it is.
So given the fact that this is going to be a challenge, and this comes after what happened in 2021 when Fed Chair Jay Powell wasn't renominated, and that some people say that's the reason why perhaps he delayed the decision to start raising rates. What does that say about the importance of Lael Brainerd's role, about why Joe Biden thought that it was so important to pick her, of all people, to lead this position?
It's going to, they're already, it's obvious that there's going to be a huge gap at the Fed as a result of this change and, job shift. But, the short version is, the question is Treasury Secretary Yellen going to stay on for very long? Is it helpful to have her in a position to migrate over there afterwards? I think that's already where the questions have landed. And, I think we've discussed this in the past. I know y'all certainly have the speculation about who will replace Yellen has been going on for a year and a half at least. So I think that's probably already a part of the dialogue as well.
Henrietta, do you think Secretary Yellen has been misused, put to one side by this administration?
I paid so much attention to the global minimum tax when it was going on. That was such a huge coup that she worked on in association with Commerce, with USTR. And then you see the consistent narrative she's had that's going to give her a lot of gravitas going into this debt ceiling debate, which we need all of. One of the things I like about the clip that you just aired is that she speaks about suspension and raising the debt ceiling in the same sentence every time she talks about it. That's going to be pivotal to actually getting the debt ceiling hiked. My expectation is that we get a suspension. House Republicans, even the 20 most far-right Republicans, are already talking about their willingness to suspend the debt ceiling. It's a benefit to investors because it will push out the X date for a debt ceiling deadline, and Treasury can backfill its coffers and start with extraordinary measures under a suspension scenario. But the negative is that the House Republican Conference and the Senate even could agree to these really short-term suspensions. Right. But I do like that he's mentioning it a lot and in the same sentence as a hike, and is not delineating between the two because they are functionally the same.
We'll see how prominent that role is in those discussions in the year to come. Henrietta, thank you. Henrietta Trays there of Vader Partners. Tom, just a feeling that she's been isolated, frozen out. I've seen several reports on that.
We've got communications here. As John was asking that question, I said, good question. I think you're absolutely dead on. And I'm going to blame her a little bit.
Why?
She's a extremely competent, venerable economist. And the Treasury Department, I'll go back to John Connolly with JFK in that terrible car in 1963. But in my childhood, Treasury wasn't framed by Andrew Mellon. It was framed by John Connolly and people forward from there who were business types like Mr. Mnuchin. And Yellen doesn't fit central casting Secretary of Treasury.
We'll pick up on that conversation a little bit later. We'll talk to Kathy Jones of Charles Schwab. The latest from Steve Englander over at Standard Chartered. He was looking for a pause from this Fed in March. He's not looking for that pause any longer. We now expect 25 basis point hikes in March and May. They were flat previously. They think the Fed peaks at 525. They're playing catch up. First it was Alan Zettner and Morgan Stanley looking for a pause. No more. Steve Englander looking for a pause. No more. The data seems to change everything. Retail sales 1 hour and 4 minutes away.
Nice.
Equities look a little something like this on the S&P 500. Softer, lighter, lower, negative. Down a little bit by a couple of tenths of 1%. We're down 0.2%. 1 hour, 15 seconds away from the retail sales report in America. Enjoying this, Tom. The Nasdaq down 0.2% also. Unchanged on the S&P 500 yesterday. Even in the face of this, yields higher on a 2-year by what? 10 basis points or something like that. 10 or 11 at the front end. 462.24. Now, the last time we were higher than this, we were at 465 on November 8th. And if you go back to November 8th, we closed that day on the S&P 500 very close to 3,800. So that just gives you an idea of where we were the last time yields were at this level. And this equity market just not move at all, Lisa, in the face of a real shift higher in yields and a recalibration, a rethink of where people think the Fed's going to end up this year.
And it's easy just to say stocks are wrong because it seems really illogical, and yet people push back and they say the facts have changed and things have gotten better. And so that's the reason why there's actually some validity behind the gains that we've been seeing.
So you think the good news is good news for equities, at least so far?
I'm not saying that I think so. I'm saying that other people are making the argument more aggressively.
Okay. Well, it's been a big year-to-date gain, that's for sure. It's just been led by tech with high yields, and it's a head-scratcher for a lot of people.
A lot of people. I'm really struggling with that. But right now, let's take a look at some of the stocks that I've been focusing on. Airbnb, we're talking about road trips. We're always going on road trips, evidently. A lot of people are going on road trips. Airbnb is doing really well and actually saw about 20% of bookings in the fourth quarter. And they expect it to be about the same in the first quarter. Just shocking. Those shares have been up about 40% so far this year, adding about almost 10% to that in pre-market trading. TripAdvisor seeing the same kind of move both year to date and today with similar types of expectations. But yes, Tom, not only are you people booking more, but it's international. That's where people are going.
Oh.
That's why the airlines are flying. Year to date, these moves are just phenomenal. Talking like 30% moves year to date on some of the airline names. And it happened really early in the year.
We're all looking at pricing. I looked at a pricing of a London hotel, and I was shocked. I was absolutely thunderstruck.
Oh, it's real money.
It's like up 60% from what I remember.
So are the flights.
Yeah.
Well,
ridiculous.
One other stock that I was looking at, Taiwan Semiconductor Manufacturing Company. Did you see this? Warren Buffett took a stake in this company that was pretty significant a couple of months ago, and then he sold all of it, or 86% of it, in the most recent filing, which is very unusual for Warren Buffett, who's a buy and hold investor. So a lot of people are thinking maybe he knows something, and the shares are lower.
I take issue with this. Is it Warren Buffett selling, or is it his team selling? Does he have anything to do with the selling? Is he directly involved in this? I don't know. I'm just bringing it up.
These are 13F filings, right?
You know, we don't say Larry Fink sold. You know, we know that it's BlackRock, but is it Mr. Buffet selling?
Is the cult of personality changing with succession ideas?
I don't know.
That's another question, but I'm not going to get into that one.
I don't know.
I hate that question, though. Do they know something we don't know?
Yes.
Do they know something we don't know? You know,
further stocks?
It's like the Fed, isn't it? The Federal Reserve, it's like,
They always know something.
He sounded cautious. Do they know something we don't know?
Yeah.
I mean, based on their performance the last couple of years, they don't know anything.
Well, I think that a lot of people are agreeing with you, and they're pushing it back against that.
Fed officials pushing for more rate hikes. That's the story of the last 24 hours. The Dallas Fed President Laurie Logan saying this: "We must remain prepared to continue rate increases for a longer period than previously anticipated. If such a path is necessary to respond to changes in the economic outlook or to offset any undesired easing in conditions." Interesting line. Kathy Jones of Charles Schwab looking for high yields off the back of some of this. It's likely that yields for bonds with 2 to 5 year maturities will continue to move higher on the shift in expectations about the path, Tom, of Fed policy. And that is precisely what we've seen in the last couple of weeks.
Triangulate it with Bloomberg Financial Conditions Index 0.42. It's really gone nowhere off of what we saw yesterday in the 2-10 spread. Round it down at negative 88 basis points, a remarkable moment in fixed income. She's chief fixed income strategist at Schwab. Kathy Jones joins us this morning. Kathy, in your note, you talk about something Fabozzi talks about, which is the shift in the yield continuum along maturity, along duration, the shift now. Where are you shifting and where to be in fixed income, given the stew out? Do you go to the belly of the curve as many people are talking? Are you brave and go out? Or are you short?
Yeah, we've moved gradually towards the intermediate part of the curve. So through the belly of the curve, we're starting to move out a bit. If we get back close to 4% on the 10-year, we'll move out a little bit further at that stage of the game. And, as I put in the note, I think that the issue was that the market had gotten too far ahead of itself in pricing Fed rate cuts and not keeping up with where the Fed was. And we had that term premium had really fallen. And part of that was also, I think, due to lower volatility in general. So we were mispriced, I think, for the path of Fed policy. And now I think we're getting back to a more realistic level. We still see inflation slowing down. We still see yields coming down long term, but the market just got way ahead of itself.
And John, this is like active, passive in equity markets. When you get active in bond markets, most of that talk is along the continuum, and that's where this word shift comes in.
We've seen a real shift in the last couple of weeks at least. So, Kathy, based on what you've seen so far, this backup in yields, that's a buy for you?
Yeah, I mean, it's not quite as far as we'd like it to go. We'd like to see maybe 385 to close to 4% on the 10-year if we can get there. And I think we might, given the vehemence that we're hearing from the Fed about hiking rates and the fact that I think the market has been a little bit too optimistic about rate cuts at the end of the year. So I think we get there, but yeah, we'll be buyers when we get there. We're more cautious now on credit than ever. I think one of the consequences right now of this rally has been because volatility has come down, the spreads have come down so much, and that's getting us more and more cautious on credit, but not so much on rates.
I think we're about 170 basis points tighter than the wides of last year, Kathy. What explains that move in your mind? Are there anything in the fundamentals that explains that move? Because Lisa was pointing this out, and it kind of makes sense. It's quite intuitive. If you think we're going to get a higher terminal rate in 2023 because the data is just good and you have to push out the recession call, isn't that a backdrop where high-yield credit should perform well?
Yeah, yes, unless the reaction function of the Fed is such that it tips us into recession. So I see that in high yield, you've had a lot of companies termed out their debt, so the rise in rates in the near term isn't affecting them. And we did see a big drop in volatility, and high yield tends to move with equity. So you get lower volatility, a better equity market, you're going to get those spreads coming in. I think what we're seeing, though, is as we get towards the end of the year and into next year, that increase in volatility from here is more likely as the Fed continues to hike. And we're seeing things like the senior loan officers tightening credit. That survey, I think, showed 41% tightening credit at this stage of the game. That's a pretty serious indicator that's sort of adverse for high yield. So yeah, they can term out the debt, they can keep going for a while, but ultimately the cycle is going to be, I think, difficult, and we'll start to see default rates come up at the end of the year and into next year, and the market's just not priced for it.
A lot of people used to think of the high-yield bond market as sort of the canary in the coal mine to tell you when there's going to be trouble. And a lot of stock analysts have come on this show and they've said, we actually like equities because credit spreads are also tight. So the credit market is actually confirming our view. Are you saying that credit no longer operates as that canary in the coal mine and is basically trading in tandem with equities and is subject to the same data and the same disruptions?
I wouldn't say it's the same data. I think they're highly correlated, so they are going to move together. But I think that what's happened in this cycle is that there was a lot of runway for high yield issuers, and there was a lot of easy conditions. What we're seeing is those conditions are changing. So I wouldn't be relying, if I don't do equities, fortunately, for me, but I wouldn't be relying on the high yield market to support my equity position at this stage of the game. I'm not sure it's confirming so much as it's using the same dynamic. But again, we get into the end of the year, we get some more rate hikes from the Fed. We're seeing a slowdown in nominal GDP, tightening in credit availability. Those are not good things for high yield.
But we could do this without necessarily seeing a default rate pick up substantially. I mean, we are seeing it tick up, certainly among certain leveraged loans and other specific CCC rated bonds. But this is sort of the conundrum. People have termed out their debt. Companies are in a better position. Why is that now not a counter argument being bearish on an asset class that, based on the past 10 years, is still offering quite a bit of yield?
It's offering a lot of yield, but not relative to what you can get in safer assets. So yeah, they've turned out that it means the default rate will only tick up probably slowly. Maybe it'll peak out at a lower level in this cycle than it has in the past. That's all good news, but when you're priced where we are in spreads today, it doesn't give you any compensation for any of that risk. So I just think it's a very complacent market right now, and it doesn't provide enough risk premium. Even though the nominal yield is high relative to what you can get just sitting in cash, it's not that great.
Kathy, run before Tom spots the piano behind you. It's good to catch up. As always, Kathy Judge, thank you. At Charles Schwab, Kathy, love it, thank you. Your bond market, 2s versus 10s, negative 87 basis points. David Rosenberg, good friend of this programme, often listens, and thank you for that, David, puts this out on Twitter. The yield curve leads the economic cycle with a classic lag of just over a year. It inverted last summer. For him, that means Q2 and Q3, Tom, have a bullseye on their foreheads.
He was
that from David just moments ago.
You know how much I worship his parsing of inflation. We had him on yesterday in the 9 o'clock hour, and he was absolutely heated, and he went classic Rosenberg, John. He went to goods inflation. I did a very careful study today of that pre-pandemic goods inflation, and the running rate is near 0%. It's 0.25%. Pretty careful study. We've gone from 11% inflation on goods all the way back to 1.44%. We're moving towards where trend was, even as we worry about the service space.
The range of views out there at the moment is just amazing.
Oh, it's stunning.
It's going to be incredible, Lisa. Someone's going to be very, very wrong about this year. Either you don't think the Fed's done enough and they need to do a whole lot more, or you think they've done too much already. And that's a pretty wide range of outcomes.
And if you take it even a step further, and the bigger idea here, that the Fed could raise rates to 5% or even potentially 6% and not cause a recession, not cause some sort of financial accident.
Can I bring something up that I just wish we had the courage to do?
What if we said no?
It doesn't matter.
Right.
I'm going to do it anyway.
Very obvious.
There's times where we watch baseball and the umps are blind, and it's usually like 3 or 4 umps in baseball. It's not like all of them. They're all really good.
Sure.
You have in England 2 guys that have been thrown out of this stupid VAR thing because of their
video
calls
assistant
last
referee.
weekend. That's brilliant.
Oh, you think it's good they got chucked out and got
Yes,
punished?
they completely screwed up,
Does
right?
that not happen?
No,
in
it doesn't
football?
happen. No.
Do you have the
never seen it.
VAR in baseball?
We have at first base. We do because it's such a tight play, and there I
interesting.
approve of it because there's often they get it wrong.
I like how rugby does it. Rugby will put a microphone on the referee, on the official, and as they look back over the video, the referee will then explain the decision on the microphone for the whole crowd to
Arsenal, Man City,
happening.
John, which is it?
Oh, that's
Arsenal,
tough
Man
call.
City. Come on, John.
You want me to choose a team?
Please, Lisa, which is it?
Arsenal.
I have no clue.
I
Arsenal,
think Man City need to bounce back and put in a performance, and I think this might be their moment. So let's see.
There we go.
And Haaland needs to get something done. He's a man under pressure.
As a hack, he's doing nothing.
And that's a problem for the team. So we'll see. I mean, look, what do I know? Are you choosing Arsenal?
Yeah.
John, you know more than we know.
I thought you were a Liverpool fan at home. No, Bramo's in. She's like,
No,
it's like game on.
but I like the Gunners.
You like the Gunners?
Yeah.
Who are the Gunners?
Arsenal. They're meant to be your enemy. Oh, for goodness sake. Still trying. 10 years plus. This is Bloomberg.
Got to make that apology for him again, Jonathan. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, China warned today that it will retaliate against the U.S. over violations of its sovereignty, potentially escalating a lingering dispute, just as both nations' foreign ministers plan to attend a security conference in Germany. China's foreign ministry spokesman claims a Chinese balloon downed by a U.S. jet had inadvertently floated over the country after being blown off course. China insists that the balloon was a weather monitoring device. Chinese pensioners returned to the streets of Wuhan to protest changes to their medical benefits. Photos and videos show a large group of people gathered under an overpass, singing and chanting while rows of police stand by. Bloomberg wasn't able to independently verify the videos. The developments come after protests against pandemic lockdowns swept through China in November. The International Energy Agency boosted forecasts for global oil demand as China reopens its economy. The agency raised estimates by 500,000 barrels a day for the first quarter and by just under half as much for the year. That would push world consumption to climb by 2 million barrels a day this year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think the most likely scenario, and I give it 50%, is that we end up with sticky inflation, 3 to 4%. There is a possibility of an orderly disinflation. I give that 25%, and there is an equal probability of 25% of a U inflation, that we find out that service inflation is very difficult to bring down.
Got lucky to catch up with Mohammed Al-Erin there, the president of Queen's College, Cambridge, and of course a Bloomberg opinion columnist, on his outlook for inflation. The likely outcome, 50% I think, was the probability he assigned to that scenario. Sticky inflation, sticky for longer. That would be a problem for this Fed. Retail sales offering you more information about this economy in 43 minutes and 12 seconds time. Equity futures look like this going into it. We're negative 0.25%. No real price action here. Yields totally unchanged at 375.31. I think one thing a lot of you have noticed recently, Tom, just some of the wild intraday moves we've seen from the lows to the highs and all over the place. It's been kind of crazy. I thought the price action yesterday, Lisa, off the back of the CPI print was kind of nuts too.
It looked like a yo-yo. It looked like somebody was just like ding, 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 playing a game. And honestly, you just wonder, not to blame the algos, but how much of this is really some sort of, I don't know, programmatic trading, because who trades off of these kinds of
Can you do that sound again? Because I'm going to cut that and then use it at the opening bell.
Ding, ding.
That's just great. Do you like that, Tom?
I think it's
sort of like
Jeopardy.
Sound effect.
It was like, you know.
Didn't there used to be a sound effect for this show? It used to be rip up the script. Have we still got that anywhere?
Didn't
we used to have that?
We blame that on. We had a consultant.
Little cartoon used to pop up and rip up a piece of paper.
Berniker Consulting handled that. We had a relationship with Berniker.
So,
yeah, it was just like, you know.
Well, so when the price action's like that, it's like ding, 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 ding,
Then
ding.
Tom, I haven't heard you say rip up the script for a long time.
Well, you know, I don't know. It's on hiatus. You know, we don't want to overdo it.
I was just going to say if you
It's
bring
not
it back.
It's not like the ads on Bloomberg. We don't want to overdo it.
Which ad?
Which ad? Moving on right now. This is an important interview. Joining us now is someone who absolutely nailed the dynamics of hydrocarbons, downstream, upstream. Here, Stephen Short joins us, principal with the Short Group. Right now. Stephen, thank you so much for being with us. I want to have a more general conversation. John, am I right that there's a massive bet on $100 barrel oil?
I would say it's a massive bet.
So.
I think there are some people out there looking for triple digit.
Yeah.
I think Jeff Curry at Goldman's one of them. And I'm pretty sure Francisco Blanchard, B of A, talked up the possibility of that happening this year too.
Stephen, it's not what you do. You don't, game or try to guess a barrel. You're looking at the micro stuff, which valves are being turned in America. How do you react to the certitude of $100 a barrel oil?
Right now, I'm not there, Tom, quite yet. Through the first 6 months of this year, we do a lot of algo, a lot of quantitative modeling here with regard to price forecasting. Right now, for the third quarter coming into this, for the first quarter coming into this year, we had the meeting of our outputs on the high end at $91 a barrel. When we go and look to the start of the summer, that mean jumps to, I'm just looking at my notes here, at $96 a barrel. And there is a potential of one $100 a barrel at some point this summer. So clearly there is that statistically that probability, and it makes sense. The demand is expected to be strong. We still, as it always, we could drain, and apparently we are going to drain the SPR because apparently it's a political slush fund. So you can take that down to zero. It still doesn't increase the amount of refinery capacity here in the United States, and therein lies the problem.
Stephen, is the Kansas City Chiefs were playing the other team, is they were playing your beloved Eagles. Every other ad was an electric car ad. Our electric vehicle usage, is that in the short hydrocarbon world now? Do you see that within the data?
Oh, absolutely. We're beginning to see it. And we're most likely seeing it in gasoline demand, Tom. Gasoline demand is problematic if you're just assuming no one's driving EVs, because demand is anemic. You have to consider this winter, and we don't have a winter. I mean, I-95 corridor up to the Maine border, there's no snow on the road. I-80 out to Wyoming, from the East Coast to Wyoming, there's no snow. So we have ideal driving conditions, and yet gasoline demand is still about 4% below a year ago. And according to our modeling, about 2% below our probabilistic range. So that means 2% below normal. And we've had a significant, it's winter grade gasoline prices, so they are cheaper than summer prices, and yet demand's not kicking in. So if you're on one hand, you're saying it's just the fossil fuels, then we've got a problem. This economy has a problem because gasoline demand is a tremendous economic leading indicator. But we do have to factor out the fact that more people are driving hybrids. Tom, I was bragging over the Super Bowl because I was crying about the Eagles, but to console myself, I kept on having to remind myself, I drive an electric hybrid SUV. I put 17 gallons of gasoline in this thing about every 4 months, and I drive 1,400 miles before I have to refill those 17 gallons. I'm getting 78, 79 miles to the gallon. That is the future. Unfortunately, we're in the EV world where it's a zero-sum game. EVs are great, but they're certainly no panacea, and they're certainly not great for the environment.
Stephen, and we can build on that point. I'm trying to understand then how you can parse out the dynamics to come in with some expectation of where prices are going to go. The International Energy Agency put out this report this morning saying world oil supply looks set to exceed demand through the first half of 2023, but the balance could quickly shift to deficit as demand recovers and some Russian output is shut in. Basically, we have no clue. Anything could happen. Exactly. Have you ever had a corollary to this?
Yeah, no, absolutely. It's we're going here, except maybe. No, this is why you do the probabilistic modeling and quantitative modeling, because you're looking at, excuse me, a series of price variance over daily returns, weekly returns, monthly returns, and you're coming out and you're running simulation models of these potential exogenous factors, these black swan events. 2 years ago, no one knew about Ukraine coming to the fore and being a major factor. 2 years ago, no one was expecting to see a hostile White House towards the U.S. hydrocarbon industry. So we do not know. So there is that random component that you have to kind of model into these probabilistic models, and then you come out with a range. So there's no such thing as an accurate forecast with regard to we're going to hit this price, we're going to hit that price. No, but you can come out with a probability of ranges of events, and hence why we're coming out with kind of the median output of all the modeling we're running is where we're getting this potential oil by the end of the summer as potentially low as $61, $62 a barrel, and as potentially high as $91, $100, $101.
Well, that's one heck of a range. Stephen, I want to squeeze one further question in. You said a line there. I think it was EVs are certainly not that environmentally friendly. Can you explain that to us?
Yeah, I mean, just look what's happening in California right now. We're at the first life cycle ending of those solar panels. California never had a plan to dispose of those solar panels. So now all the heavy metal, those solar panels are sitting in dumps with the potential of all the heavy metals in there leaking out into the environment. And now when you factor in the fact that EVs are such a small percentage of the global market, when we talk about the amount of earth And we're talking about something about the size of the state of Arizona and Nevada, just here in the United States, to state our demand. The amount of earth you're going to have to rip up to get to these heavy metals. So we're ripping up China. We're going to rip up the Congo, which we already are. We're going to rip up Argentina to get to the cobalt there. When we have to rip up that earth, it will make 120, 130 years of coal mining and oil drilling look like a pinprick of the amount of environmental degradation we're going to have to do to get those virtue signaling heavy metals into that EV battery.
Stephen, why aren't we having that conversation more?
I don't know. I mean, because we're such a fractured political nation. If I'm saying something, 50% of the people watching this think I'm nuts and think I'm pushing some sort of agenda. I'm just looking for a meeting of the minds, and I want to really promote my hybrid. It's the best of both worlds. It's a little bit of fossil fuels, which we need because demand's not going away there, and it's a little bit of electricity. It's a little bit of both,
Stephen,
and it's a great compromise.
We love you. We love you. We love the different opinions, and we love how you've taken the Eagles' defeat.
You're just taking a jab at the Eagles.
And that comes on the heels of the Phillies, Tom. So this has been a tough year for Philadelphia.
For Philadelphia, it's been a brutal sports year.
Yeah.
Didn't you lose MLS as well? Isn't it like the trio?
I think so.
All three?
Yeah, Short's never going to come back if you keep it up, John.
Stephen Short gets short grip. I'm not sure he cares about that third point. I'm not sure if he watches MLS. Stephen, thank you. You might be watching the golf this weekend. The Genesis Invitational. Tiger Woods.
Don't know. Oh, yeah.
So Tiger Woods has played some majors, but hasn't played on the regular tour since 2020. He's going to tee up tomorrow. I think this is 3 p.m. Eastern Time. McIlroy, Justin Thomas, Tiger Woods. That's your pairings. The threesome. With the three of them.
We don't have time here for it. Where are we on the Saudi Arabia uproar? There's like 2 golf tours.
There is.
Is that still out
the
there?
fight, the battle continues. Yeah. Live Golf. Is it Live Golf? Live Golf? Live Golf?
You know, I could see us with CBS at the Masters, the three of us.
Wouldn't that be amazing?
Down there.
I'd just take tickets. It's so relaxing, that tournament.
No one wants my commentary.
Such a beautiful thing.
Oh,
you should listen to the commentary at the
golf.
Masters at Augusta. It is so relaxing. It's like therapy.
I know, that's why.
Just
I'd
beautiful.
be bad at it.
Markets ahead of us are actually optimistic that somehow we're going to avoid a real slowdown.
The volatility has been pretty contained on the equity side.
Even though inflation is going to be above its comfort zone this year, we don't think it's going to act in a way that's going to try and drive the economy into recession.
We don't know what's going on. The labor market has all these distortions that are coming off. The economy has all these distortions that are coming off.
The minute the markets sniff, that the Fed might not have to go quite as much, financial conditions ease.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. Retail Wednesday is what it is after a Tuesday inflation. John, markets moving still off inflation, maybe in front of retail. 210 spread, that difference in yield. I'm going to call it a new low, round it down, negative 90 basis points. I'm on the 100 basis point watch.
10 basis
Never
points
said
away.
that.
Pick
Never
up at the
said
front
that.
end. It's a move in the front end again. The 2-year yield high by 3 basis points. New high of the year, very close to 465 a little bit earlier this morning. In fact, about 10 minutes ago, 464.79. Off the back of the better data, this shake-up really started around payrolls Friday, that blowout number.
Yeah.
And ever since, there's been this risk that we start to price in a higher terminal rate at the Federal Reserve, more sticky inflation. You push out that peak in yields, you push out that peak from the Fed, and you basically price out rate cuts this year. And that's slowly been happening over the last few weeks.
People adjusting. You saw Harvey the other day go
Bear
on
market
equity.
over.
Bear market's over. You had Englander earlier from Standard Charter adjusting a Fed call as well. I would adjust to the great academic Kenneth Rogoff. Of course, this time is different as the iconic effort with Reinhardt. And what he said, Lisa, and it was in the opening montage we did there, we don't know what is going on. If Rogoff doesn't know what's going on, I don't think any of us do.
Well, nobody knows what's going on. So the question is, what's your compass and what's your reaction function, both from the Federal Reserve, but also as an investor? Is your compass to clip a coupon? Is your investor, is your thesis to really go with momentum? And this is where it really is someone's investing theory that really has to reign supreme, and flexibility, nimbleness to change.
And with a compass, as Lisa looks at what is your compass, we can say it's part of our journey.
Our journey. Our journey. It's the journey, not the destination. I love what Julian Emmanuel of Evercore said a couple of weeks ago. He said, if you're not confused, you're not paying attention. Because this is really, really confusing stuff for a lot of people. And if you are confused looking at the incoming information and thinking, what on earth is happening? You're not alone. I get the sense that the Federal Reserve is also equally as confused, particularly after that jobs report. They just don't know what to do. So their phrase that they lean on when they get really confused is that we will remain data dependent and we need to wait for more data. And that's because they've lost conviction about what they're about to do. They had so much conviction last summer. It's just very simple. We're going to hike interest rates. Inflation's too high. We've got a problem. Then all of a sudden it's like long and variable lags, we hope. You know,
maybe.
I feel like long and variable lags is what you say when you just have no idea what's about to happen. Because they use that phrase, Tom, as if it's scientific. That like we've done all this and there are long and variable lags and it's going to hit at like this point at this time and this is what it's going to do. No one's got a clue.
You have a very good point in that it harkens back 3-4 decades. I'm going to give association to Chicago and Milton Friedman. I could be wrong on that. But the answer is we're using dated terminology and some would say dated theories like Phillips curve in a modern time.
There also is this nuance that the data is becoming less and less reliable in certain components. And you raised this point, John, earlier, that Fed officials themselves keep talking about their surprise with the labor market report from Friday. And there was this article in the Bloomberg Businessweek magazine this week talking about how people don't answer those surveys. You always get surveys, and people don't answer them, and it makes the surveys a lot less reliable. So it starts to really raise this issue. What are we relying on to really make our call on the economy, especially if it's going to get revised in a couple of months?
Are you saying UMich is a problem?
I wasn't casting aspersions on University.
Participating.
I'd
love to get them on one day. I really want to talk about that.
You think that they want to talk with us right now?
That would be
possibly. I think it would be a really interesting conversation.
I agree.
I want to understand how they put that data together. And the question I'm interested in is the long-term inflation expectations component of that survey. You know, do they give them a range to play off?
Right. Otherwise,
if you just call someone random at home, they probably feel like inflation's up like 10, 15, 20%. That might be how they actually feel about it, because when they go food shopping, grocery shopping, Tom, that's what it looks like to them.
In retail sales, we're going to have here is on a nominal basis again. On an inflation basis, we're going to see that, and food's going to be a part of that, and shelter indirectly. We heard earlier from Sarah House of Wells Fargo that Amazon and all that we do there plays into retail sales. We do that in 24 minutes, 52 seconds. John, we got to wander through the data. There's no other data point for me today. 2's, negative 90 basis points is a pre-immisera wow statistic.
And that lift in the front end and that deeper curve inversion, Tom, at negative 90, there's the number for you. Going into retail sales 25 minutes away with futures backing off as well, down about 1/3 of 1%. So a bit of risk aversion. What was interesting about yesterday is we had that move in the front end, did not have this move in the equity market. We were totally unchanged. A disconnect for some of you, for others perhaps not, but we'll see how that plays out in the couple of days we've still got of this week.
Over the years, for so many, it has been an interesting conversation to speak to and listen to James Bianco. Jim Bianco's president and macro strategist at Bianco Research. It's a wonderful, holistic note because he's listening to Wall Street. Jim, I like what you do in your note this morning. You reach out to the recent work from Deutsche Bank to Apollo of Torsten Slok, and you're looking at the no landing scenario that he and others are talking about. Tell us on the possibility of a no landing.
No, I think that the no landing scenario, using the plane metaphor, that it just continues at 30,000 feet is growing every day. And what is driving that is the labor market, as we all know, or as I like to say, the problem with the labor market is there is no problem with the labor market. And if there isn't a problem with the labor market, the Fed is not going to see a reason to pivot. And something new is starting to come up in the marketplace in just the last few days. The probability that the Fed raises rates in June to go to 5.5 is now gone above 50%. And that's the first time, I believe, this cycle that the market has actually gotten ahead of the Fed. The whole cycle has always been the Fed has said they're going to do something and the market thinks, now they're going to pivot, they're going to step down, they're going to pause, they're not going to go as far as they think. Now the market's starting to think the Fed's going to go further than they are communicating right now. So something has changed, and I think what that is the inflation report yesterday. Services are not in disinflation. They look very sticky right now, and we have a positive base effect meaning that we're dropping off big numbers from last year, 0.7 in February, 1% in March on the inflation report. And once we get past June, that all turns and it becomes a tailwind for inflation to push higher. So we might not get to 2%. And then the second half of the year, we start moving higher. And I think that's what the market's starting to sniff out.
So, Jim, we've repriced yields higher, treasuries lower. We've priced in a higher terminal rate as well. Why are equities so resilient in the face of that? What do you make of that?
Well, I think there's a couple things going on with equities. The first thing is 40% of the rally in the equity market's 8 stocks. It's the FANG stocks plus Microsoft, NVIDIA, and Tesla. It's 2021 all over again. We've even got Bed Bath & Beyond moving, and we've got, the meme stocks starting to go. So we've seen this movie before. And so when you strip that out and you look at the rest of the market, it's up. I mean, it's not down or anything. It's up, but it's not up nearly as much as everybody thinks. But I think the problem the equity market's going to face, hey, no landing, that means earnings are going to come back, that's bullish. The forward PE ratio, the PE ratio of what earnings are expected to be in the next year is 18.5. You're not paying a cheap multiple for this market. You're going to pay full for this market if you're going to bet on some kind of economic rebound.
What are variable lags then in this scenario, given that we're not seeing it and that if by anything, we're seeing easier financial conditions?
Yeah, I think that's going to be the biggest concern that we're going to have when we go forward here is the uncomfortable question of maybe the Fed is not at sufficiently restrictive. Maybe what we're at 4.5 on our way to 5 on the funds rate is neutral. And that's all we've done in the last year is gone to neutral. That's why we're having a no landing. That's why the inflation rate is being so sticky. And that we all assume, and I think that's what was the assumption behind all the recession calls at the beginning of the year, was we've raised rates a lot. That's got to hurt. But maybe it doesn't. Maybe all we've done is gone to neutral. And that's what the market's starting to sniff out, why we're starting to see it price in 5.5, is that we're not at sufficiently restrictive and we've got further to go.
Jim, what do you make of that phrase, long and variable lags? How relevant is that to this moment?
It's relevant to the extent, going on what a lot of other people are saying about that this is an unusual market and they're having a hard time understanding it. I come back to it's a post-COVID economy. Now, I know that's a fancy word, but what that means is all the rules that we understood about the economy pre-COVID, they've changed. And the biggest one we all know about is work from home. Barely half of the offices in the United States are now occupied 5 days a week. Everybody's on some kind of range of remote work. That is a huge change in the economy. And there's been other huge changes in the post-pandemic economy. So when people say I'm confused, I don't understand, the economy isn't behaving, we have to look for long and variable lags, we have to be data dependent. I think what it is that they're saying, when is it going to start looking like 2019? The rules have changed, and we need to start to figure out what those rules are. I don't know what they are. I just know they're not 2019's rules.
And John Bianco breathing the oxygen of long and variable lags. Milton Friedman, University of Chicago, which is why Bianco is so long in variable lags.
So long variable lags.
It's the monetarism and the ether in the air 30, 40 years ago.
Jim's going to stick with us, Jim Bianco of Bianco Research. Tom, given how dependent we are on financial markets, much more so in the last few decades.
Very important observation.
Do those lags get shorter? I mean, isn't that basically the observation we thought? That was the conclusion we had in the last 12 months. And now here we are talking about long and variable lags again.
Without question, the financialization and the communication speed has changed the dialogue. But still, there are larger macro features at hand. I'm with Jim that the pandemic has messed up any analog back to the past.
To build on that, this idea of when do we start seeing long and variable lags, we don't know what we're going to see when the economy gets back to a more stable state, because just what he was saying, we're not going back to 2019.
These theories are carrying a lot of baggage from the past.
Got a great line from a Bloomberg subscriber just moments ago. The economy is like the recent balloons we've seen. It will just keep drifting until it pops. Futures right now, -0.4. Retail sales, 18 minutes away. It wasn't Lisa.
And the balloons have a compass.
This is Bloomberg.
But I relate.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Scottish First Minister Nicola Sturgeon resigned after more than 8 years as head of the country's government and independence movement. in a surprise move that will reverberate across UK politics.
This decision comes from a deeper and longer term assessment. I know it might seem sudden, but I have been wrestling with it, albeit with oscillating levels of intensity for some weeks.
The decision to step down comes after an unusually turbulent time for Sturgeon and leaves her Scottish National Party and the Independence campaign looking for a new figurehead without a clear roadmap. European Commission President Ursula von der Leyen says the European Union's new sanctions package would target $11 billion worth of goods via trade bans and technology used in drones, missiles, and helicopters. Draft proposals seen by Bloomberg show the EU is poised to force banks to report information on Russian central bank assets as part of the bloc's latest sanctions package targeting Moscow for its war in Ukraine. The UK isn't considering backdating pay raises for NHS staff and other key workers, according to a government official. The Financial Times reported Prime Minister Rishi Sunak and Chancellor of the Exchequer Jeremy Hunt are considering a pay offer that would see higher wages kick in from April of this year, alongside a lump sum payment that would effectively backdate the pay increase to January. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We don't know what's going on. The labor market, has all these distortions that are coming off. The economy has all these distortions that are coming off. And you don't want to, race ahead like you know what you're doing for sure. I wouldn't be surprised if interest rates end up at 6 to bring down inflation.
What a number. But the key line in there is we don't know what's going on. That was Ken Rogoff, the Harvard professor of economics and former IMF chief economist. That is an incredibly sophisticated, smart individual just saying, we don't know what's going on here, TK. I don't know where this is going.
If Bullard was 15 years younger at Indiana University, his PhD text would have been Obstfeld-Rogoff. That's how important what we heard from Professor Rogoff.
What do you make of the possibility of 6?
I need to re-listen to Bob Seger is my answer. I'm looking at the BTMM screen. Jim Bianco's doing the same thing, and we are going back to another time and place, John. And for a huge percentage of our listeners and viewers, this is a whole new world after all.
We'll get excited about retail sales in 13 minutes' time,
Yeah.
but jobless claims come tomorrow. 200,000 is the estimate. So that's another tick higher, a second week of it, if we get it. But 200,000, that is not population adjusted. So 200,000 going all the way back to, what, the 60s? I mean, these are incredibly low numbers.
I think about what we just heard there from Jim Bianco, which is maybe we're not at sufficiently restrictive, if you want to use the same lingo, right? Just to give you a sense of, we don't know where we are, but the strength is making us question what the new model is at a time when you say, what do you make of 6%? Well, what do you make of the unemployment rate where it is? What do you make of these numbers? And we don't know where that will rest with respect to growth and inflation.
Matt Lazzetti put out a note yesterday, and thanks, Matt, for reaching out and informing us all of your new call, which is 560 as a peak Fed funds rate, and he made 3 points. So I share those 3 points with all of you. First, the labour market is so far remarkably resilient to Fed tightening. Second, less progress has been made towards disinflation with the revision to these CPI data and yesterday's CPI print. And third, financial conditions have failed to tighten enough. Those 3 points, Tom.
Yeah.
Conclusion, for him at least, the Fed needs to go higher.
Bloomberg Financial Conditions Index come back a little bit, but not really. 0.429 signifies that accommodation. We continue with Jim Bianco, President of Macro Strategist Bianco at Researcher. I want to dovetail Reinhard Rogoff, Jim, into what we're going to see here in 11 minutes, 24 seconds. And that is, this time is different within consumer America. We're off a pandemic. Are we acting almost in a drunken state because this time is different after the shock of a pandemic? Or is this just typical boom from stimulus?
I think it's more typical boom from stimulus. Bank of America has put out a lot of statistics about balances in everybody's checking account, and they're still very elevated. So a lot of the stimulus money that we saw handed out in 2020 and 2021, especially at the lower income levels, haven't been spent. And so these people still have spending power. And I think we're starting to see that. We don't see a booming economy, but what we do see is numbers that are continuing to move forward. The retail sales numbers are expected to rebound. Remember, December they were negative, and they're supposed to be up a decent amount, maybe 2% when we get them, meaning that spending will be continuing. And if we're talking about a recession and a pivot, and we're talking about 3.4% unemployment, and we start seeing spending, I got to think at the Federal Reserve, they look around and go, I don't see any reason to even think about pivot, let alone think about stopping raising rates. And 5.5 looks like a target that we're going to head
Well,
for.
I'm going to go to 5.5%, and let's just pretend there the 3-month LIBOR from another time and place gets back to 5.5%, and that gets us back to a Bob Seger economy. I was mentioning the giant of the Midwest there. Great, Jim, but are we prepared for the way we adapt and adjust if we get back to Rogoff 6% or a 5.5% 3-month LIBOR?
No, I think that that's going to be a difficult adjustment for us, because if we get back to a 6% funds rate, we would probably have a 6% Treasury bill rate. Look, we just hit 5% yesterday on the 6-month bill. That is the first Treasury security to yield 5 in 15 years. If we start to see 6 on those numbers, all of a sudden people are going to look around and go, what's the long-term return in the stock market? It's 9 or 10%. I could get 6 without taking any risk whatsoever by parking it in a Treasury bill or a short-term Treasury security. That is going to prove to be a lot of competition for the idea that the stock market can continue to roar ahead.
Which is the reason why a lot of people say that the bond market's inversion that you're seeing in the 210 spread is somewhat indicative of what's to come with respect to recession and stocks. Do you think that this time is different, that it is not a predictive measure of a downturn in, say, 12 months?
I'm not so sure I'd go that far to say that it's not predictive. I'll put some numbers on it. I tend to look like Cam Harvey of Duke, who's the guy that developed the yield curve indicator, that when it persistently inverts. That happened around Thanksgiving, when it was 10 days in a row that it inverted. And it usually leads by about 10 months. That would put you in the fourth quarter for a recession on average, but it can be as long as 18 months. That could put you out in the first or second quarter of next year. So we could still be a year away from the recession, and the yield curve will have worked as an indicator. But I don't think Wall Street's that patient. I think that the whole idea that the Fed's got to pivot, that there's a recession, a downturn coming, I don't think they think, well, it'll be here in a year. I think they think it'll be here in 90 days or 120 days. So yes, the yield curve still might work, except we just have to dial our expectations that it still might be a 2024 scenario where we see the downturn or recession and not the middle of this year.
If we do prolong when a recession comes, will it be a more problematic recession because of how far the Fed will have to raise rates in response to sort of an easing that we're seeing in financial conditions and the strength in the economy?
You know, it can be a more problematic recession if it is, you know, going back to Bob Seger again, if it is a recession or an inflation-driven recession, that we see the inflation rate staying very elevated. I don't know if the Fed will have to raise rates as much, but they're not going to see recession and say, okay, here we go, back to zero in quantitative easing. They'll probably say maybe we got to cut rates back to 3 or to 2.5, and then see how things go. And I think a lot of people are expecting that in a downturn, it's going to be a road right back to zero on interest rates, and we might not see that this time around.
Jim, financial conditions, how do you track that? What do you look at, and what do you think the Fed's looking at?
You know, that's a good question, because there's all different financial conditions indicators. They all measure things differently. The Fed has various measures as well. If I was to look at it, I look at the more traditional Goldman Sachs type of indicators, and that says that they've eased a lot. And then anecdotally, with zero DTE options, with meme stocks like Bed Bath & Beyond doubling in a day, with the FANG stock starting to move, it seems like it's a very easy environment right now, and it is not a tight environment, and that should be concerning over at the Fed. And that's why I was very confused when Chairman Powell was talking about tightening financial conditions at his press conference a couple of weeks ago, because that's not the case by a lot of measures right now.
What's amazing about this is, and on Bloomberg Radio, you're not observing this, but over the right shoulder of Jim Bianco is this Monroe trader from another time. And, I'm sorry, we're hearkening back to interest rates when Bianco was using the Monroe Trader to figure out convexity and duration.
Back then, I'm not sure he was talking about zero DTE options.
No, he was not talking
Jim,
about...
I've got about 60 seconds left to squeeze that in. So that's 0 days to expiry options at the index level, really short-term stuff. Now, Jim, can you tell me how much you think that has shaken this market about?
Yeah, what has happened is that they now list options every day and they expire every day, and about half the volume is in options that will expire today. I think what it's done is it's created intraday volatility. So you see these big swings from, like yesterday was a great example of it, right? Up 1%, down 1%, close around unchanged. Day-to-day volatility, maybe it doesn't really impact that. But we have to be ready for this idea that, hey, look, the market's up 1%. What does it mean? Wait an hour. It's now down on the day. Wait an hour. It's back up on the day. That's where I think that the zero DTE options are really starting to play into the market and confusing a lot of people.
We need a new promo. What does it mean? And then we'll just play Jim Bianco.
It's great.
Talking about zero DTE.
Is that your pitch?
I love this extended conversation
so great,
with Jim
so
Bianco.
great at marketing. Jim, thank you, buddy. Jim. Appreciate that. 2 segments with Jim Bianco of Bianco Research. That was enjoyable.
Alec Tanzi, giant for Bloomberg with Reed Pickett right up. John Ferro on surveys. And I didn't know this, to your point, on Michigan surveys. It's becoming difficult. Erica Groshin, the great research economist, says John Ferro is right. Surveys are becoming suspect.
Interesting. Okay.
Nobody picks up the phone.
Futures down 0.4%. Retail sales in America. Up next. "23 seconds away from retail sales data in America. Equity futures shaping up as follows going into the print. Equity futures right now on the S&P 500 look a little something like this. We're negative 0.4%. Yields higher by almost a basis point on a 10-year, 3.75 on a 2-year. We came very, very close to 465 plus just moments ago, 466 in the last 10 seconds. With your data, here's Mike McKee.
Well, John, we're going to start with retail sales because that's what everybody wants to see, and it is a big beat this time. Get your soft landing story ready. Up 3%. After a 1.1% decline in the prior month on trying to get the download of the Census Bureau's update here. The ex-autos number is also strong, 2.3%. It was down 1.1% in the initial print last time. And that's important because we knew auto sales were very big in January, and that would add a lot. So we've got some beyond auto sales there. Take out gasoline as well, 2.6%. So it looks like Americans were happy to spend some money this past month. The control group, which economists follow because that's what goes into the GDP report, up 1.7%. That was after a negative 0.7 print in the initial report last month. So it looks like some very strong numbers here in terms of retail sales. Americans out there spending some money. I'll get the breakdown while you look at the market reaction, which I'm going to guess is, I'm not looking at it, but I'm going to guess you've got some market reaction.
Yeah, you don't need to look at it, Mike. You can guess. Equity futures down about 0.5%. That's not a major move, but we push higher again on a 2-year yield. We come very close to 470.
Look at the revision.
467, yields higher by about 6 basis points. 2-year versus 10-year still in and around negative 90 basis points. That's the 2-year versus the 10-year. Equity futures a bit softer, yields a bit higher, the dollar a bit stronger. Euro dollar 106.81. Tom, off the back of that upside surprise on retail sales.
There's so many things to watch here. You mentioned the 2-year yield with a 6 basis point move. What I'm watching is the revisions, and they go in the trend of this good shock retail spending in America. I want to remind everyone this is a nominal statistic, inflation folded in, and Mike McKee will do this, but on the control group, the revision, John, is negative 0.7 to a better negative 0.4. So that's even more oomph to this optimism on retail.
1.7, the actual number on the control group for the month of January. The estimate was 0.9%. Credit to Samuel Coffin over at UBS, who was looking for 1.6, and credit also to Mike Gapin, who got this directionally correct. He was looking for a big upside surprise because in their credit card data for the month of January, they just saw fantastic activity. Now, you put this together with what we've seen in jobless claims, still sub 200, what you saw in payrolls in January, and whether you think this is the right conclusion or not, this is the consensus right now. and it's shifted. It's shifted towards a higher terminal rate and an extension of this expansion through this year, Tom.
And on radio, we've got the right chart up. 2's10 spread, legs down to a negative 91 basis points. And, we're somewhat on the negative 100 basis point watch, which is historic. But, John, what I would suggest is back to what matters for listeners and viewers. The American economy is avoiding recession. In the fourth quarter, there was gloom. I believe the running statistic now is positive 3.1%. How are we going to shift in April? How are we going to shift the second week of May of our view of where we are right now?
It's proving to be more resilient than people thought it was. Though, Mike McKee, you've had some time to go over this data. Some people might be asking, is this just a quirk of the calendar? Is this something about the month of January that we're struggling to figure out?
There may be some quirks in it, but it is kind of unusual to see the amount of strength we're seeing. I told you motor vehicles were strong, and certainly they were. Motor vehicle and parts dealers up 5.9%, and cars alone up 6.4% during the month. So it looks like everybody waited to spend their holiday cash on cars in January. Also, gasoline prices. Gasoline prices add a lot to the retail sales numbers because they were down by 4.8% in the month of December, but they were flat in January, so that did add. But there is strength across the board here. Building materials up 0.3%, electronics 3.5%, furniture stores up 4.4%, health and personal care stores 1.9%, and Tom, you help the economy. Food services and drinking places up 7.2%. That is quite an astounding number.
That's astounding. I mean,
that is
astounding.
It's the only services number in this retail sales report.
Right.
And it's very discretionary. So people, despite what they may be telling pollsters, are apparently confident enough to go out and spend on discretionary things.
Well, Mike, let's rip up the script here because I think it's so important. It's about taking the price, as we saw with Coca-Cola yesterday. People pay more for Lay's potato chips. You see it in the beverage sector as well. Do you see any reticence to spend money given higher prices?
It doesn't look like it, although we did see a decline in food, not a decline, but a very small rise in food and beverage stores, up just 0.1%. So people were not spending as much as they had in the prior months, but that may be inflation affected. But overall, it looks like people were just happy to open their wallets. Now, remember, sales were not good in December, and you wonder how much of that was people waiting for sales that either didn't come or started to come in January, because we did see this huge rebound here. And that as I said earlier, can help boost the soft landing scenario that people are talking about.
Hey, Mike, thank you. More juice, more fuel for that scenario. That view, at least this morning. Mike McKee there with retail sales delivering an upside surprise. Your 2-year came very close to 470 at 469.68. That print right there, a new high for 2023. Right now, 467. Yields higher across the curve, up by 5 basis points on a 2-year to about 467. On a 10-year high by 4 basis points to about 378-ish. You can call it 378, 377, 379, whatever you want. Round that up, Tom. The move in the FX market, bit of dollar strength for you. Euro dollar shaping up as follows. Euro dollar looks a little something like this at 106.92. But overwhelmingly, Tom, great data in America to kick off the year. Hard data looking rock solid.
I think of a lot of people in Congress going, I know the Fed wants to break our backs and slow us down, but it's not happening. This is a joy. It's been a really wonderful joy in these busy 3 days as our team has put together wonderful voices. Ken Rogoff yesterday, Jim Bianco moments ago. Terry Weissman is a global interest rate strategist and currency strategist at Macquarie with decades of experience in this. Are you close to amending your view? Are you close to making a Macquarie shift here? Or is it pretty much like, okay, this is what we've been dealt, full speed ahead?
I think it's fair to say we're going to delay our view, not amend our view. Our view has been that there will be a recession in the U.S. this year. It's clearly not going to start in the first quarter, based on all the evidence we've gathered so far on sales, on employment trends. But on the other hand, surveys are still pointing to a recession coming in the U.S. Look at the PMIs; they're below 50 for both services and manufacturing. When you look at the survey of consumer expectations coming out of the New York Fed last week, it is still pointing to downbeat expectations. So are the Michigan surveys, the Conference Board surveys. The consumer, while he might be spending, is not in a happy mood, Tom. And I think that we're going to see.
How can you say the consumer's not in a happy mood given the data I just saw?
These are fluctuations. These are not trends. Look, there was a lot of spending in October in the U.S. by the consumer who was afraid of inflation taking away his ability to properly gather the gifts he needed for Christmas. They were afraid of hotel rooms being fully booked. They were afraid of airlines being fully booked. They did a lot of spending in October ahead of what they would normally do. That caused a big jump in consumption. But was that a reflection of a positive mood? Not necessarily. Inflation has a way of making people fear the future, and they spend now as opposed to
and you
later.
heard that from Barkin yesterday. That's exactly what Barkin and Richmond said.
Yeah, and then look, once all that spending got through in October, November, we had a pretty dull December in terms of spending, especially when you adjust by where inflation was. So January's seeing a bit of a bounce back from that. Admittedly, I always remind my desk people though, you gotta take these numbers and deflate them, make them in real terms. It doesn't look that great for spending.
Yeah, but you said something interesting there. It's about the inflationary backdrop, that you buy now because you're worried that prices go up later. Isn't that something that carries on spiraling? Isn't that something that becomes entrenched, that behavior? That's not something that typically would just fade away.
But it cannot continue forever because obviously budgets are limited. But it also, inflation has a way of eventually breaking the back of that spending. Eventually you see your real wages erode, you see your real income erode because of inflation, and you're forced to settle into a lower level of spending because of it in real terms. So yeah, it could happen for a short amount of time, Jonathan. It could happen for a few months. It can't happen indefinitely.
So what's the head fake here? The weakness in December or the strength in January?
We've had three head fakes, right? We've had employment in January much stronger than most people surmised. We then had inflation come down less than people surmised. Now we have a boost to retail spending in January that's greater than people surmised.
Well, maybe it's just
reality, There have been three head fakes. I'm sorry?
Why isn't it just reality? Why isn't that just an accurate characterization of where we are, which
it is
stronger than we thought?
It is an accurate reflection of where we are. What I'm talking about is the future, not now, right? We're not saying, as I said, that the recession is starting now. And in fact, like I said, there's nothing consistent in the data to suggest that the recession is upon us. But in the next few months, you're going to start to see the U.S. economy weaken. And it's going to be in the context of a global economy that might actually continue to strengthen. Our view, for example, on the dollar is predicated on that. We don't think that the weakness in the dollar is over, in part because we see a more deeper recession coming in the U.S. and North America generally than we do in the rest of the world.
In what we've seen here, from inflation to retail, we have claims tomorrow, John?
We do, tomorrow morning,
200,000. We're as data dependent as I've ever seen. We make jokes about it. We've got a countdown clock. You like our countdown clock?
I love your countdown clock.
We're all into our countdown. Would you put up the Arsenal Man City countdown clock, please?
It's like the atomic clock. It's accurate to the millisecond.
I remember when you were at Bear Stearns and we waited 10 days for MeltPass to approve an edit on what Emmy Shia was doing. I mean, it was slow motion. What does all this hyperventilating about data do to us and critically to the Fed?
It makes us crazy. It makes me crazy from time to time. Admittedly, it's difficult to be certain in the trends that you're looking at when you see these fluctuations. But look, I'm gonna tell you that there's a lot of things that the market is getting wrong right now. I think they're underestimating the amount of credit tightness there is in the U.S. If you look at the loan officer survey, if you look at the NFIB survey of small business lending, it is collapsing. It's at recessionary levels. At least with regard to things that are pertinent to the Fed, the credit markets, things look recessionary or about to go into a recession in the U.S.
Terry, this was great, and we appreciate your perspective as always. Terry Wiseman there of Macquarie on an upside surprise on retail sales. We wanted the date, Leo Brainerd, to start at the NEC, the National Economic Council, as Bindard's new director on February 21st, according to one official. We'll continue this conversation with Jack Manley of JP Morgan Asset Management, Mo Hagman of Invesco, Nadia Lovell of UBS in the next hour on Bloomberg TV. Equity futures on the S&P 500 negative 0.6%, and yields higher across the curve.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Turkish stocks soared on their return from a week-long suspension after authorities threw their full weight behind investors. Turkish authorities suspended trading on February 8th and canceled trades made that day after 2 earthquakes hit parts of Turkey and Syria, killing more than 40,000 people. The threat of more air and missile strikes remains across Ukraine as Russia attempts to gain full control over the Donetsk and Luhansk regions. Canada's defense minister reconfirmed NATO support to Ukraine and called for Putin to leave the country.
If Putin wants this war to end, all he has to do is leave Ukraine. And that is exactly what the fact of the matter is. And until that occurs, we are going to be standing strongly with our Ukrainian counterparts.
Anand spoke exclusively to Bloomberg on the sidelines of NATO's defense ministers' meeting in Brussels. Ray Dalio, the founder of hedge fund Bridgewater Associates, says China is coming out on top in the trade war with the U.S., adding the standoff between the world's 2 biggest economies likely won't escalate into military conflict. The billionaire investor told a conference in Dubai today that the real winners of the confrontation will be those able to tap into both the U.S. and China. Washington and Beijing have clashed on issues, including human rights, trade, and competition for technology and markets. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
When you're the largest player in the world, as we are, most restaurants of any other company, we have some scale advantages that allow us to navigate some of these trickier challenges better than most. As we mentioned on our earnings call, we think that we're past the peak of inflation in most of the markets that we operate in, and we're seeing a little bit more of a return to normal in the consumer environment.
David Gibbs, Young Brands there on a more prosaic part of the retail business. If you're just joining us on radio and television, retail sales are a Dana Telsey boom. She was way out front on that. We're going to get perspective in a moment. Futures negative 14. The VIX 18.96. And Lisa, we're all watching the bond market.
Well, yeah, this is really where you're seeing a repricing even more so. And honestly, it is interesting that you aren't seeing more of it in the stock market. 2-year yields surging to the highest levels this year, at one point hitting 4.7%. But that 6-month T-bill yield through 5% once again to the highest levels going back to 2007. The Fed has more work to do.
We're going to talk about prosaic economics of retail. That's what we do. But what's far more important here is in spring and post-pandemic New York, there's something going on in luxury. Dana Telsey owns the high ground here. She is chief executive officer of Telsey Advisory Group with a family fabric that speaks of Fifth Avenue at 57th Street. Dana, I'm not going to mince words. The windows are screaming at me post-pandemic here, except for one house. I want you to explain to our international audience at Kering Group, and good morning to Kering, who've been very kind to me over the years. Gucci is a train wreck. What's this new guy going to do at Gucci? Sabato De Sarno, how does he pick up the pieces on their underperformance?
One of the elements of luxury that always makes brands reinvent themselves, they have archives. You can go back and reinvent what was successful in the past with the twist of what's modern in today that appeals to younger consumers, that appeals to an international consumer. He has, frankly, the luxury, no pun intended, of being able to capture everyone's interest. I think you can redo the logo. I think you can redo the clothing and the leather goods. I think you can put out some new items that become iconic. Look what Daniel Lee did at Bottega and created a bag.
And he's now at Burberry's.
He's now at Burberry. Yeah. He's going to make Burberry interesting. And I always believe there's a 15-year life cycle to a bunch of these designers.
What's so important here, Lisa, to the aspiration of this is Yu Darvish of the San Diego Padres just signed a 6-year extension. He's Japanese. And there he is in the Burberry plaid, top to bottom. I mean, that's the world Dana's living in.
Are the retail sales we just got a real really speaking to this question on the luxury purchaser, on the wealthy individual, or is this broad-based?
Broad-based. I think what was interesting about the January sales number, obviously it was very strong. You looked at apparel, you looked at furniture, they showed strength also, in addition to a big uptick in restaurants. Keep in mind, I don't take January as seriously as I take March, April, and May. January is about clearing out promotional and clearance goods. You're hearing about retailers having inventory levels that were up 20 and 30% in the third quarter, and now they're down in the fourth quarter. The fact that you went from up 20 and 30 and now you're negative, you moved product, some of it at markdowns.
So just to build on that, how much is also fueled, pardon the pun, on this idea that gasoline prices are lower, so people had more discretionary spending?
You have that, plus take a look at the savings rate. People have been using their savings to live on, given the strength in essentials prices. We saw food inflation yesterday, and it's high. Those cost of eggs don't come down.
So how sustainable is this, given the fact that some people are expecting that the savings will go down by the middle or the third quarter of this year?
I think these rates are extraordinarily high. I think that we will get more moderation as we go to March going forward. I think the comparison with Omicron also definitely boosted sales in the month of January. The other thing we saw is the flip to physical stores. I think that, frankly, can hold a little bit.
The flip to physical stores and perhaps unfortunate for the Federal Reserve, a flip back to physical goods on sort of the car and the other space. How much do you start to expect a reacceleration of some of the inflation in those areas as people have been sitting on their hands for a bit, waiting for things to stabilize and are now getting back in?
I expect that to reaccelerate. I think we'll see some acceleration there on some of the basic goods. I think some of the discretionary items, though, the price increases are over. If anything, I've heard of some retailers, some categories looking to maybe reduce prices by 5% or so from the increases they took last year.
Span this over to the Joe Feldman world. Span it over, and it's in retail sales, is Amazon. I mean, we've gone from a digital space to talking about the windows in luxury New York City. Who's going to win the war?
I think overall it's going to be the innovative retailers that win the war. What you're seeing out there right now, I mean, home always remains relevant and important, whether it's remodels, whether it's new and existing home sales that need to pick up in order to drive gains there. But one of the surprising things is you saw a pickup in electronics too. And I think new items and new innovation drives electronic sales.
I'm afraid to ask. Which electronic sales are Lisa and I going to see at our house?
You're going to see newness in televisions. I think is going to be one of the new items. I think there's going to be some new items also with laptops. I think the smaller, more micro items become ever more popular.
So when do we start to see some sort of diminishing in this momentum? And people are talking about this with the surprising strength in the economy. From your vantage point, when do we see it in what they're willing to buy?
I think overall we've seen it in discretionary. Discretionary sales have moderated given inflationary pressures. I think overall discretionary continues to move on steadily. It'll be the back half where you see some improvement. I think the lower to middle income consumer, where you've seen the trade down, is what I'm concerned about as we go through this first half of the year.
Can you build on that? How much are you starting to see some fractures, some fissures in people who don't have that same discretionary spending? We're talking about windows on Fifth Avenue. But the reality is food, rent, cars, all of this is incredibly expensive and really biting into the average American.
So what we've heard so far is you're seeing even customers with $100,000 household incomes, companies like Walmart, are seeing more consumers who have that level of household income. You're seeing some of the lower tier companies, some of the dollar store and even off-pricers, where their average household income they were getting was under $40,000, and now consumers with $60,000 household income are going there. The trade down is real, and that's what impacts, I think, the March go-forward time period when inflationary pressures moderate in the big picture.
Have we cleared inventory? 90 days ago, we were all wringing our hands about stuff. I've always learned price clears inventory. Once again, that's what happened?
Yeah, that's what happened. On the same side, price cleared inventory, you're going to see inventory come down. For some, it was up 20 and 30% at the end of the third quarter. It'll be negative in the fourth quarter. But one of the other elements of that, wholesale accounts like department stores are moderating orders for the first half of the year.
So what's
You're seeing
Macy's
lower
doing?
orders.
Cut to the chase here. Macy's, they don't have the wooden escalator anymore. They're there. They've had a wonderful strategy of going to the middle or maybe the lower middle as well. What's Macy's doing to get through the summer to get the back to school?
You know what they're doing? They're using data science to modernize their department store in order to figure out what categories are working and how to price appropriately.
So more makeup is the answer.
Look at toys. They've brought in Toys R Us. They've brought in Pandora Jewelry. They have an Apple in-store shop. They've expanded the categories in order to capture more wallet share while remaining competitive on
wallet
price.
Share. That's Lisa, that's good.
So,
you put the wallet share in your new bag. That's what you do.
The wallet share is going to the stores and not staying in the wallet, and that is what we're seeing right now. And what is interesting is the market trying to understand this, because on one hand, bad, because that means the Fed's going to raise rates. On the other hand, good, because that means that companies are going to keep getting the revenue from that, Tom.
And then what's the flow through to the margins?
Right.
I think in 2023, we have more clarity on margins than sales increases.
10 seconds. We've got to go to a research note. Dana Telsey, single best buy right now.
Single best buy right now, I like Ralph Lauren, I like Deckers.
Very good. Dana Telsey with us today with enthusiasm on an enthusiastic retail report. Every once in a while, a note comes out that stops you. Moments ago, J.P. Morgan and their leader, Bruce Kasman, publishing a blistering critique of R-Star. They call it the R-Star Industrial Complex, and it's a long, thoughtful essay from the gentleman from Columbia, Kasman, and I assume Sue Michael Ferroli helping out here. They say look for a higher neutral rate.
That's exactly what we heard also from Jim Bianco, this question of what is the new normal? It is not 2018, and perhaps the Fed isn't as restrictive as some people think.
I'm not going to mince words. This is an important research effort. Don't get it from us. We protect the copyright of all of our guests. You can go to J.P. Morgan to get the Kasman note, which really is something as he walks through Laubach and Williams and the rest on R-Star and the certitude that it will come down. And Ken Rogoff touched on this. Ken Rogoff pushed against his wonderful colleague, Olivier Blanchard. Blanchard's talking about a quiescent R-Star, and Rogoff just said, maybe not.
Especially because perhaps this central bank won't have the conviction to go the last mile, as we were hearing about from Sarah House.
Never boring. We're going to do claims tomorrow after this bang-up retail sales statistic as well. Futures at -12. The VIX, it was a 23, weeks ago? 18.94. Exit stage life. Brian Deese at 12 noon. This is Bloomberg.